A very warm welcome to this year's annual conference of IOPA here in Frankfurt. The title of this year's conference is From Uncertainty to Strength, Supervision for an Economy in Transformation. My name is Annette Weisbach and I have the honor to be your Master of Ceremony during today's event. Of course, the challenges for the economy are multifold right now. We're talking about record high inflation, still low yields, and all these challenges are, of course, also a topic for insurance supervision. But not just those topics, but also the protection gap or protection gaps will be tackled today, and also the new risks which are emerging, like cyber risks, but also the S in S&G. And also we are talking in ESG, of course, and also we are talking about the rise of new risks like cyber risk, as I was saying, ESG, but also an old risk which we are facing since many years, climate change, which will be a topic during today's panels. But before we get started, I'd like to introduce you to some housekeeping notes. For those who have been joining last year and the years before, we are using an interactive tool called Slido, which enables you to ask questions, but also enables us to ask questions to the audience. So please, we try a little bit of a test now, whether you can use the interactive device. It's please type sli.do on your phone or browser, and then use the code IOPA conference with a hashtag before, and then we can try we can try that question, and we can have a look whether you can use the app. So the question is very easy: who is watching today? Are you part of the supervisory community, from the industry, from academia, a policymaker, or a consultant? So take your time to answer that question, and we pull the results up, and throughout the day we're going to use that interactive device, but you also, as I was saying, can ask questions through the Slido interface. So it seems that the majority of participants are coming from the industry, but the bars are still moving. So part of the supervisory community is very strongly coming in second, 32% right now. Yeah. So I think it's a fair picture to say that the majority of participants are part of the supervisory community, and the second biggest part of people is coming from the industry. But that was just a test to give you an idea of how to use it, and so we can use that interactive device a little bit later during the day as well. As always, we also have a graphic artist joining us and actually giving us a visual impression of the debate. This year it's Sophie. Hi, Sophie. And we'll check with Sophie a little bit later as well on various occasions during the day and have a look at how she's actually transforming the debate into cartoons. Thank you very much, Sophie. But I'm also hearing that our first speaker is already ready and standing by in Brussels, and I have the honor to introduce Mairead McGuinness. She's Commissioner for Financial Services, Financial Stability, and of course the Capital Markets Union. Good morning, Mairead. The floor is yours.
Well, a very good morning, and thank you indeed for the introduction and the invitation to be with you. So wherever you are, whether you're industry or supervisors, I think this conference is really important because we are living in a time of enormous change and enormous uncertainty. So even the title, I think, really fits the mood. So we're talking about uncertainty to strength, supervision in transformation. We all know that Russia's war of aggression against Ukraine is shifting the geopolitical landscape. Inflation is pushing up prices, interest rates are expected to increase. And while the COVID crisis is no longer in the headlines, it has not gone away, and we need to be mindful of that. We're also facing a climate crisis, and digitalization is rapidly accelerating. There's also a backdrop to the way we are about changing demographics. So we are getting older, living longer than ever before, and having fewer children. And I do think we need to be prepared for whatever the future might hold. But building up a strong financial system can help us be ready and be prepared. In this regard, the insurance and pension sectors are vital as we seek to move from uncertainty to strength. Insurance companies help citizens and individuals, businesses to manage the risks they face in this uncertain world. Pension providers help individuals prepare for their long-term futures. And together, they channel money into the economy with a particular potential to make long-term investments that are really important to build a resilient economy. And given the geopolitical events, this is more urgent than ever. However, that potential to invest is not yet fully used. So today I want to talk about what we can do to change that. Now, the precondition for this is a strong and resilient sector that can cope with macroeconomic shocks. And that's why we do need strong prudential rules. In 2016, Solvency II was introduced. It was a major change in the European rulebook for insurers. It was a revolution that aligned prudential rules with state-of-the-art risk management practices. And it has worked well. But Solvency II has to be fit for purpose and fit for the future, which is why we presented our review in September of last year. And we are grateful for the high-quality input from EIOPA that contributed to that review. So our reforms aim to boost insurers' investment capacity, ensure that our insurers take climate risks into account in their risk management, ensure that Solvency II is applied in a simple manner for smaller, less complex insurers, and overall to improve the resilience of the sector. The proposals would release up to 30 billion euros of capital, which would foster the insurance sector's investment capacity. You may know that member states approved their position on the Solvency II review recently, and the position of the European Parliament is expected to be voted before the end of this year. So I can look forward to negotiations on a final outcome in the following year. When it comes to prudential rules on pensions, the Institutions for Occupational Retirement Provision Directive has improved rules on governance, information provision and cross-border business. And it was one of the first pieces of EU financial services legislation that referred to environmental, social and governance risks. As you know, a review of this directive was envisaged for 2023. But there have been delays in transposing the directive in several member states. And that's why I believe that more time is needed to prepare for any reform in this area. And we will need extensive consultations. My services in DG FISMA recently sent EIOPA a call for advice as part of this process. And again, I'm grateful for the work which EIOPA will carry out to provide that advice. Occupational retirement provision is a well-established and highly successful tool in many European countries, and it can reduce the burden on national pension systems and ultimately provide large groups of employees with a safer and higher pension income. And it's something I think that our younger generation are certainly interested in and talking about, given how they will move jobs and careers over the span of their working life. So if I look at any future reform of the IORP directive, it will need to build on the success. And then beyond the resilience of the sector, we also want to help it make its contribution to our capital markets. The European financial system is, as you know, still too fragmented along national lines, and this is a weakness, but in my view, it's also an opportunity because it means we can change the situation and get stronger. And here we want to deepen the capital markets union. And our capital markets have to be a real source of financing for companies, a real investment opportunity for savers, and a real shock absorber in case other funding channels don't work. And pensions and insurance companies should play their full part. Long-term investments in equity and green infrastructure should attract insurance companies. But in practice, insurers have been retreating from long-term assets, and the actual share of their investments in the real economy and in green infrastructure remains limited. Our Solvency II reform looked at how to unlock long-term capital from the sector. Now, if we look more broadly, one key element for CMU is building up critical infrastructures within the European Union that are both robust and competitive. And this includes central counterparties, or CCPs. These entities work behind the scenes, but they're absolutely vital for well-functioning capital markets. Third country CCPs, in particular those based in the United Kingdom, are very important for EU market participants. However, the EU's current level of over-reliance on a third country for central clearing is not sustainable in the medium term, and it is a cause for a concern on financial stability grounds. Because a large stress on these CCPs, like a failure of a clearing member, would be a significant risk for the European Union's financial stability, and EU authorities would not be in the driving seat to tackle the fallout. So we need to address this risk, and my strategy on clearing is a priority for this year. We understand from stakeholders that more market participants should be required to clear or facilitated in clearing, and this would foster liquidity at EU CCPs. These market participants would include, for example, pension funds, insurance companies, and investment funds. Pension scheme arrangements, or PSAs, have an important role to play in this strategy. More pension scheme arrangements have voluntarily moved towards central clearing over the last number of years, at least for part of their derivatives portfolio. Now, currently, PSAs are exempted from central clearing, but this is on a temporary basis. We listened to the concerns expressed by pension funds, particularly smaller ones, which were not ready to centrally clear their portfolio of derivatives. On June 9th, we adopted a decision to prolong this exemption one more time, and indeed one last time, until June 2023. This will allow PSAs to complete their preparations for central clearing, as well as additional time to explore solutions to the challenges they're facing. And this extension, of course, is subject to the scrutiny of the European Parliament and the Council. But I would stress that this is the final extension. As and from June 2023, PSAs will have to clear. And there is an expectation that PSAs will clear at EU CCPs when that exemption expires. EU CCPs have taken steps to meet PSA's clearing needs, introducing specific arrangements facilitating PSA's access to repo market liquidity and to clearing. And I believe these initiatives improve the central clearing options available to PSAs in the European Union. As I move then from the infrastructure to the individual, the CMU can support the provision of pensions, and IOPA has played a pivotal role in our work so far. Our CMU action plan aims to increase the participation of EU citizens in capital markets to meet their future financial needs, including more income for retirement. And that can also help EU capital markets expand and help EU companies find the financing they need. Auto-enrolment schemes are national schemes where individuals are automatically signed up to a pension plan, of course, with the possibility to opt out. Our goal in this area is to foster transparency and support good practices. Just last year, we published a study analysing auto-enrolment practices in a number of EU and non-EU countries. And it shows that auto-enrolment schemes can be useful to foster citizens' participation in financial markets. And the study also lays out best practices for establishing these schemes. In parallel, we asked IOPA to help us to identify best practices in setting up national tracking systems for individual pension rights. And these systems provide individuals with future pension projections based on their entitlements and contributions, so they're more aware of their pension rights early on. And I think all of us will recall that the idea of a retirement when you start in your career is something that's extremely distant and abstract. But of course, a retirement does come, and these systems can help address that issue of people starting in a career not looking immediately at what they might need when they retire. So IOPA has already delivered a detailed blueprint on how such schemes can be set up at the national level and how they can be connected at a European level. And finally, we tasked IOPA to explore the creation of a pension dashboard to build a comprehensive view at both EU and member state level of the adequacy of national pension systems and to create suitable benchmarks for comparison across member states. Now that this preparatory work is done, we will continue to gather views from stakeholders and reflect on the next steps in these areas. Diversifying our base of investors means that we need to support retail investors. And again, the benefits are twofold. For the retail investor, who can make better returns on their money than in a savings account and prepare for their future, and for the availability of capital on our financial markets. The Commission will publish a strategy on retail investment early next year. And again, my thanks to IOPA, to EBA and ESMA for their advice in this area. I know that the timing was challenging and that the topics were difficult ones, but we appreciate your support and effort. Here we want in the Commission to strike the right balance between improving investor protection while at the same time avoiding unnecessary red tape for the financial industry. It's also very important to provide a level playing field for all financial services while ensuring that the features of each sector are taken full account of. Financial products and investor protection must adjust to the rapid evolution in the way firms interact with their clients and the way retail clients may consider investing. So we're focusing on factors that may help increase the trust of retail investors, ranging from work on financial education or financial literacy to how information is actually disclosed. We're also looking at how products are designed and distributed to retail investors. And overall, we want retail investors to feel empowered to participate more actively and to have trust in capital markets. Now, of course, that trust also depends on fair treatment of clients by the financial system. And here I want to mention the concept of right to be forgotten of cancer survivors, because we know that cancer survivors report that they often face financial discrimination and have difficulty accessing products like mortgages and life insurance even many years after their treatment has concluded. And we believe that this is unfair and it needs to be addressed. Some member states have already legislated to protect survivors' right to be forgotten. You know, we have Europe's Beating Cancer Plan, and in that plan we are stepping up at EU level to address this particular issue. We want the increasing number of people with cancer in long-term remission to be able to access financial services fairly. And indeed, many of us will face these diseases, and indeed many in this audience may already have, and therefore we know that this issue has to be addressed. So here, in this regard, on May the 30th, we presented the results of a study on access to financial products, specifically for cancer survivors in the European Union, and set out the next steps for action. We will gather more evidence and encourage dialogue between national authorities, patients, and the financial sector. And our aim here is to publish the first EU Code of Conduct for cancer survivors' right to be forgotten by early 2024. So just to conclude, the world is changing and so is the financial sector. We need to work together, policymakers, the industry and civil society, to make sure it changes for the better. And indeed, we know that these changes are more rapid because of digitalization than at other times in the past. So for the remainder of the mandate, we will do our utmost to provide European insurers and pensions with effective prudential rules for a strong and resilient insurance and pension sector that's able to cope with macroeconomic shocks, and at the same time, the right incentives to invest to tackle the challenges that we face. And indeed, again, referring to the state of the globe and the state of the world and geopolitics, we know that Europe needs urgently to ramp up investments in renewable energies, and therefore we should waste no time to put everything in place to facilitate those investments. So thank you for your attention, and I wish you a really excellent conference.
Thank you very much for setting the scene to that day where we'll be covering a lot of those topics which you have been raising as well. Thank you very much indeed. So here we move on to our second keynote speech, From Uncertainty to Strength, Supervision for an Economy in Transformation. And I'm very honored to introduce the new chair of IOPA, who's standing next to me, Petra Hielkema, the floor is yours, I would say, Petra, and to have your keynote, the first keynote. It's exciting.
Thank you very much. Thank you very much, Annette. And good morning, everyone. And thank you very much to, of course, Commissioner McGuinness for opening this conference this morning. Thank you for sharing with us your ideas and the many files we're working on to together build a strong sector that can help consumers, can help economies, can help our society to deal with the uncertainty that is ahead of us. And also on behalf of IOPA, let me warmly welcome you all today here at our conference. I'm here on the 28th floor in our building in Frankfurt, and I would have wished to all meet you, of course, in person, but I'm also very happy that we can today reach so many people online. Now, the theme of our conference today is From Uncertainty to Strength, Supervision for an Economy in Transition. And let me say, without doubt, we are in a period of uncertainty. Without doubt, we are in a period of transformation, and without doubt, we will need to build our strength, our individual strength, our organizational strength, and our collective strength to ensure that we can meet the challenges that we face. This is what we will be looking at today. How together we manage the uncertainty and the transformation that we are experiencing and leverage our strength to ensure robust insurance and pension sectors in Europe. And in my remarks this morning, I want to address some of the issues that we are facing and how we at IOPA want to address those, where possible with you. Now let me start with uncertainty. Let's face it, the unprovoked military aggression of Russia against Ukraine has dampened the optimism that we had at the beginning of the year as the coronavirus threat receded. And the Russian invasion has provoked a humanitarian crisis, a political crisis, an economic crisis. One that not is only urgent now, but that will also impact many economic and political decisions in the future. Indeed, the impact will be far-reaching, both in time as well as geography. Since the beginning of the year, we have been observing an abrupt change in the economic and financial situation, with the effects accelerating during the last period. Supply chain disruption, spiking energy and commodity prices triggered by the prolonged pandemic crisis, and geopolitical tensions. They are shifting the narrative from one dominated by protracted low yield and low inflation to an economic juncture driven by high inflation and uncertain economic growth. For insurers, uncertainty in the economic condition and tightening in monetary policy are causing an increase in risk premia and of the risk-free rate with potentially mixed effects on capital positions. Corrections in the values of assets and of liabilities can materialize, and the latter might be counterbalanced by the effect of inflation on claims. And in addition, liquidity positions might be challenged by the potential margin calls on the hedging portfolios, intensifying short-term liquidity needs. These new conditions have implications for policyholders, depending on the type of policy underwritten. Life coverage, whose benefits and guarantees are usually nominal, are negatively impacted in real terms. Yet profit participation-based products might benefit from the higher yields. For consumers, inflation means a cost of living crisis and some hard choices. And here not everyone will be able to see the long-term impact when making choices in order to deal with short-term challenges. Across Europe, people will be asking themselves, should I let my insurance policy lapse and hope for the best? Should I reduce my pension contributions, just for now? Do I need to put off my retirement plans, or should I take a chance on that investment I saw online as a quick way to make some extra cash? Now, it's not for us as supervisors to tell policyholders what insurance cover they need or which policy they could drop. Nor is it our place to advise people on how much they should be saving on retirement. But it is our responsibility to make sure that people understand what inflation could mean for their financial health, both in the immediate as well as longer term. And it is our responsibility to make sure that the products offered to policyholders offer value for money, that people's needs are put first before profit, and that they are sold the products that are right for their individual situation. And it is also our responsibility to make sure that consumers have access to the right information and the right advice so they can make better informed decisions. This means that we need to make sure that disclosure documents are truly consumer-focused and adapted for the digital age. That advice, including advice given by a person, not a chat box or a website, is available. And for pension products, availability for clear annual benefit statements and dashboards will be key. And finally, it is our responsibility to identify and monitor gaps, whether they be advice gaps, protection gaps, pension gaps, or digital gaps, and see how we can address them. We may not always be able to close the gaps completely, but we must do what we can to narrow them. We are a society and an economy in transition. And I'm sure that everyone joining us today will appreciate just how much digital technology is changing our lives. And as a supervisor, we have to approach digitalization with an open mind. It can offer many benefits, but there are also risks. And we need to be able to manage those risks in order to maintain stability and trust. And so we rely on both regulation and supervision to make sure that consumers remain protected. Today, in one of our panels, you will hear about the importance of regulatory frameworks being ready to adapt to new risk. This is certainly the case with digitalization, where we have to remain agile to preserve our operational resilience. And on top of this, the digital transformation is also accelerating the interconnectedness of financial services, so that regulation is now becoming more horizontal. The AI Act and DORA, the Digital Operational Resilience Act, are just two examples. Our role at IOPA is to make sure that the sectors we supervise are well represented in new cross-sectoral and also in horizontal regulation. Take the AI Act, for example. We welcome the Act and support the objectives and principles of the European Commission's legislative proposal to promote an ethical and trustworthy use of AI. But we also believe that the Act needs some further reflection to make sure that the specifics of the insurance sector are taken into account. To give two examples. First, we don't believe that all insurance use cases should be included in the Act's list of high-risk use cases. Not all AI systems pose the same opportunities or risks. In case of insurance, the use of AI in pricing and underwriting will arguably have a higher impact on consumers and insurance firms than, for example, the use of AI in the back office. So we need to think carefully about what we label as high risk. Second, we need to recognize that the insurance industry is already regulated and that national supervisors are already acting on the use of AI as we speak. Indeed, these national supervisors know best how their sectors operate and are well placed to supervise the use of AI in insurance and pensions. And for this reason, we believe that IOPA, together with national competent authorities, should remain responsible for the development and implementation of further regulation and supervision of the use of AI in the insurance and pension sector, while of course working closely together with the AI board, preventing gaps, but also preventing overlap and confusion. Now let's talk about sustainability, for sustainability is the other great transformation that we are facing. It's a necessary one. Climate change-related events are more frequent and more intense than ever before. And I'm sure that you are all familiar with the extent of our work in this area. We are incorporating sustainability principles into Solvency II, IORP II, and the IDD, as well as technical standards for the SFDR. And we have two mandates on sustainability as part of the Solvency II review. One related to the analysis of a dedicated prudential treatment of exposures related to assets and activities associated substantially with the environmental and/or social objectives, and one to the reassessment of natural catastrophe underwriting risk capital charges. And we are conducting our first climate stress test this year for IORPS, as we look at the effects of environmental risks on the resilience of this sector. This is a lot, and at the same time, it's all urgent. And so there will continue to be tough choices and difficult conversations to make and to do for insurers, pension fund managers, and supervisors as we take on this mammoth task of greening our economy. But it is also a chance, for here insurers in particular play a valuable role in keeping cover affordable for policyholders. Indeed, with data, innovation and incentives, insurers are helping businesses and people prepare for the future, managing society's risks to the extent possible, and also sometimes indicating where the possibilities become limited. And all this is relevant and needs to be discussed. My message to industry, to policymakers and supervisors is that IOPA is here to listen, certainly, but also to foster cooperation and to facilitate knowledge and data sharing in order to take on this challenge as an industry, not only with Europe, but also at the international level. I also emphasize that sustainability is not limited to environmental factors like climate change and indeed nature risk. we must also consider social and governance factors, the S and the G of the ESG that we talk about so often. It is true that there are fewer scientific indicators for these areas, but that does not mean that we should ignore them, and we will continue to support the work of the European Commission and the Sustainable Finance Platform to develop these areas. Now, transformation should be all about opportunity, and most of the time it is. But there is also the risk that some people are left behind, or already are left behind. And here I would like to say something about diversity and about gender. For too long, people have faced and are still facing discrimination because of gender, ethnicity, cultural background, sexual preference. We have seen how important it is for gender and all these other aspects of diversity to be on the agenda for all insurers and pension funds. And for this reason, we have recently written to the European Commission, to European Parliament and Council, calling for diversity of management bodies in insurers and pension funds, and having that reflected in Solvency II and IO2. This too is a badly needed transformation that will have a positive impact across both our sectors. I really believe in that. Ladies and gentlemen, uncertainty can make us feel powerless. Transformation can be confusing. But on the other hand, strength can be empowering. So we have to build on our strengths. At EIOPA, our strength is dialogue, cooperation and supervision. And the foundation of our supervision is good regulation. And so we take it seriously when we are asked to provide advice on potential future legislation, and I just gave the example on the AI Act earlier. But there are other important areas where we need the voice of insurance and pensions to be heard, like the retail investment strategy. When we create frameworks to protect retail investors, we have to recognize how many investment products are insurance-based and the special role that distributors and intermediaries play when bringing these products to consumers. If we want people to be able to take full advantage of the opportunities that the Capital Markets Union offers, then we must make sure that the specificities of insurance and the insurance sector, including intermediaries and the distribution of these products, including products with guarantees, are fully understood. We also take seriously our responsibility when reviewing existing frameworks, just as we have done with Solvency II and will now do with IRRD, the IOP2 and soon the IDD. And as we approach the final leg of Solvency II negotiations, it is important to remember that policyholder protection is always our priority. With robust frameworks in place, we can concentrate and monitor emerging trends and threats and deal with those. Because the single market offers so many possibilities, and we cannot afford to put it at risk. This also means we will have to confront home-host issues. The digital transformation means that more services are being provided cross-border, reaching more people. In fact, cross-border premiums have been steadily increasing over the past 5 years compared to domestic premiums. In most cases, these services are there to benefit, and they do benefit the European consumer. But it can also mean that consumers are buying policies without knowing from which country they are buying their policy, without knowing who is ultimately responsible if things go wrong, and without realizing that the impact that it could have on them in case an insurer fails. Now, in the full spirit of our internal market, this should not be a problem. However, unfortunately, we are seeing more cases with policyholders in one member state receiving less protection and, in case of failure, less compensation than policyholders in another state. That, in my opinion, is unacceptable. And it is therefore that EIOPA stresses that minimum harmonization of insurance guarantee scheme is very much needed. Supervision is our strength, but we are only as strong as our powers permit. Too often it has taken us too long to resolve these cross-border cases. And as an EU body mandated to safeguard financial stability and protect consumers, this puts us in an uneasy position. So we will need to make some decisions. If there is right now no appetite for a single insurance supervisor in Europe, we still must see how we can address this particular shortfall. This problem will not go away. And no matter how resilient the sector, how robust the regulation, we will sometimes have to deal with failure, and we need to be ready for that. And this is also why EIOPA is paying close attention to the development of the Commission's proposal for minimum harmonized insurance recovery and resolutions directive. This makes sense for financial stability, and it makes sense for policyholders. And when we at EIOPA say that consumer protection is at the heart of our work, I want that to be a statement that we can live by. Now let me conclude. The speed of transformation will set the pace for supervision and in many cases will outpace regulation. And to make the best of the transformation, to create opportunities, to mitigate the risks, we must build our strength. The financial crisis of 2008 showed us the importance of robust regulatory frameworks. More recently, COVID, climate change and cyber have shown why working together is often the only way to address challenges. And today, the Russian invasion of Ukraine is showing us that our European values are our strength, that diversity is our strength, and that our belief in cooperation and acting together is our strength. Ladies and gentlemen, we really are stronger together, and it is this joint strength that will carry us through this uncertainty and period of transformation. I thank you very much, and I hope you enjoyed the day. Thank you.
Petra, thank you very much. But before I let you go, I have a couple of questions for you. We have to get perhaps a little bit of a personal impression from your first, is it, I don't know,
9 months?
9 months.
9 months.
It is now 9 months. So what were your first impressions that have been reinforced now over those past 9 months?
That's a good question, actually, and it gives me an opportunity to say that I did expect to work with talented people, but also very motivated people in a European and international setting. And I found that not only in my office with great staff, but also among my members, my stakeholders, and I enjoy that. And it's probably even better when you do it now and more also in person, and I enjoyed it very much. What I also expected is that I would be able to contribute to society and to supporting the transformation that we are going through. And I really feel that every day when I go to work, I do believe that I'm actually doing that together with a great team. So it makes my job very nice.
And what has surprised you? What have you perhaps been not expecting the job to be like, or like from perhaps also topic-wise?
Yeah. Well, to be frank, one thing you don't really see, and I think that's a good thing, I think that is part of being also a supervisor, is besides the policy and the advice that we do, that indeed we are having a key role when it comes to home host issues, and we try to deal with that as confidential as we should. But at the same time, there are several cases where we can step in and can support a positive outcome when between member states things are not going well, although in some cases indeed we would like to be able to do a bit more, and so that was something I didn't know before, but I do feel that having that role, also having been a frontline supervisor myself, is a good role for EIOPA to play in the European industry and sector between supervisors. Maybe the second, what I of course didn't know, was that we would have these additional risks with the invasion into Russia and the inflation that is now happening. But what I do see here is that the ability of my community, members and insurers, but also of Europe as a whole, to stand together and deal with the challenges, how quickly we were able to find each other and to start getting into action, and how well supported that was as a group, I think that was a very positive finding that I had.
So there are many pressing issues on your agenda, but which ones would you prioritize?
Yeah, there are many pressing issues, and it would be tempting to mention a few, for there are many, and I touched on them in the speech. But I would say that if you take a step back, the overall challenge will be not only for EIOPA and our members, but also for industry, is to actually deal with all those issues in parallel, not missing out of any risk in the individual cases or individual topics, but at the same time also keeping an eye on how they interact in order to have an overall result that is better for both stability and consumers.
You've been mentioning the crisis, the invasion in the Ukraine. Is that crisis, or the war, we should call it, postponing some reforms, some things you would rather tackle faster?
That's a good question, and that is of course something that that sometimes comes up in the discussion. But what I would feel is that indeed the aggression and the war of Russia in Ukraine is contributing to unity in the EU, and is moreover putting even more urgency on the agenda on sustainability. I'm not saying it's making it easier, but I do feel that the urgency that there is for this transition that we need to undertake has even grown, but has also become more clear. And I think in that sense, it's not delaying the agenda.
Protection gaps are a big topic, just moving into the topics now. How concerned are you about this, the growth in protection gaps, and what has changed perhaps as well from perhaps a year ago?
Yeah. I think that what we see is that indeed there are more and more protection gaps, and they are in many fields. So you see it in business interruption, and that came up during the pandemic. You see it, of course, in when it comes to climate change and the extent to which these risks are insured, the extent to which consumers actually take out these insurance. This raises question. We now see the same questions coming up in cyber, and then for sure there is an issue with a pension gap in a continent that is aging, and 1 in 5 Europeans not having enough saved for a good retirement, and I think the situation for women is even worse. So this is a concern, and I think where the discussion is developing towards is that it's becoming more informed. It's becoming more data-driven and more evidence-based, and I think we need to continue on that route, and we very much would like to support also that discussion in that way by facilitating with data and with evidence, with open-source dashboards. We're making one for NatCat right now, to share where the risks are, what the drivers are, and what could be done to deal with them. For gaps can be closed by mitigation, can be insured where possible, but sometimes also more is needed in a public-private discussion. And I think we need to step by step identify what are the gaps and what solutions would be needed. And again, I think we're doing a better job on that right now than we've done a year ago when it comes to how informed the discussion is.
Yeah, but my last question for you would be moving fast forward in 4 years towards the end of your term. Where do you want to be with EIOPA? How should the institution look like?
Yeah, that's a nice question. I really want to build on the success of Gabriel, my predecessor. I think he really built an authority that's recognized. I would like to build that even beyond our sector and pensions and insurance, be recognized beyond that. I would very much like to be an institution that's part of the city of Frankfurt. I think there's a lot happening here, also in the financial industry, and it's a lovely place to work in. I would very much like our organization to be a place where people really like to work, and that is reflecting the diversity of our society. But moreover, I would like to do that in an industry that is stable and robust to start with, but that is also recognized for the very positive role it can play in the transition towards a greener economy in a time of digitalization. And I truly believe we can make very good steps to get there in the next 4 years.
Well, thank you so much. Thank you, Petra, and enjoy this conference, which will be your first annual one, right?
Thank you.
Thank you. So we are moving on. The next big topic will be a panel on protection gaps, which will be, of course, moderated by Pamela Schurmans. She's principal expert on insurance policy with EIOPA. So we're talking about protection gaps. We've been hearing from Petra, which of course is a huge topic for the industry. With protection gap is a variety of subtopics. We can tackle it with respect to cyber security, but of course savings are a crucial issue. We've just been hearing from Petra that 1 in 5 Europeans do actually have a huge protection gap when it comes to their retirement or their pensions. We have to talk about protection gaps in respect to digitalization, but also natural catastrophes do play a role. We have been seeing some years of massive natural catastrophes also happening here in Europe. And of course, there's an awful lot of different topics which have been or have to be discussed when we talk about protection gaps, not alone the high inflation as well, which is currently, of course, in combination with still a low yield environment, at least when it comes to the Eurozone. The next Yeah, as I was saying, the topic will be on protection gaps, addressing behavioral change. And I think with that, I'd like to hand it over to you, Pamela.
Thank you very much, and a very good morning and welcome to the first panel of today. The panel is about protection gaps. Now, you may say we have discussed protection gaps already at our conference in 2019 and in 2021, and it's true. The coronavirus pandemic unveiled a lack of cover for many businesses against business interruption. And we've seen through our NatCat insurance protection gap dashboard that only 35% of losses from natural catastrophes in Europe are insured today. So why are we then discussing protection gaps again? There are two big reasons. For EIOPA, addressing such gaps is a strategic priority, because these gaps can affect the value proposition of insurance and pension solutions, but also they can create risks to consumers and financial stability. And protection gaps seem to grow in number and importance. Cybersecurity incidents are increasing, with potentially new gaps appearing. And the pension gap is one of the most serious issues facing our society, which will be aging much faster in the next 30 years than in the last 30 years. So as already announced in the conference agenda, addressing protection gaps is not easily solved by selling more financial products, because consumers may choose not to buy the products, and insurers may decide not to offer insurance anymore or exclude certain risks from coverage. And where the government steps in, this may even reduce consumers' or insurers' incentive to manage risks. And it is this behavior that may lead to suboptimal outcomes at individual or collective level. That is why today we want to address another and potentially fundamental aspect to addressing society's protection gaps: human behavior. To what extent can insights in human behavior explain and help us addressing protection gaps better? At EIOPA, we're convinced there is a need of addressing protection gaps from the start. Setting the right behavioral incentives to optimize decision-making, especially geared towards risk prevention, is a key element to this endeavor. And this is what I want to discuss today with our panelists. I very much welcome our panelists, whom I will briefly introduce. Hello to everyone. Good to see you. I'm sure many of the audience participants know you already very well, but let me allow you to briefly introduce Stéphanie. Stéphanie Joncourtin is a French member of the European Parliament in the Renew Europe group. She's the vice chair of the Committee on Economic and Monetary Affairs, known as ECON, and particularly involved in legislative discussions related to insurance and distribution of financial products, notably as shadow rapporteur for the Solvency II review, for the Insurance Distribution Directive, and for the PRIPS regulation. So this means Stéphanie is very knowledgeable about the regulatory challenges and opportunities attached to integrating sustainability aspects in conduct and prudential frameworks. Turning to Michaela. Michaela Koller is Director General of Insurance Europe, the European Insurance and Reinsurance Federation, and currently also Secretary General of the Global Federation of Insurance Associations. She has been a member of both insurance and pension stakeholder groups of EIOPA and currently chairs the EIOPA's Insurance and Reinsurance Stakeholder Group. This means she is closely and critically reviewing EIOPA's initiatives on sustainable finance and protection gaps. Turning to Monique. Monique Gooyens is a Director General of BEUC, the European Consumers Organization, bringing together independent national consumer associations across Europe, and this to ensure that consumer interests are duly taken on board in policy. She's been contributing to various fora on behalf of BEUC, including on artificial intelligence, connected products, and challenges in product safety. She's also been a member of the Commission Expert Group on online disinformation. This means that Monique can help us in understanding what consumers actually want from financial products and the gaps they may experience. Turning to Darren. Darren, Professor Duxbury, is the Chair of Finance at Newcastle University and an international expert in the areas of experimental and behavioral finance. As a co-investigator of a UK Research and Innovation Global Challenges Research Fund, he is currently involved in applying his behavioral expertise to better understand financial and economic behavior to inform economic decision-making and risk mitigation for delta improvements. So Darren will kick off the panel and help us to navigate the discussion around key behavioral concepts and hopefully manage any cognitive overload as we go along. So, on behalf of the panels and myself, I'm very much looking forward to the discussion, also with the audience. So we would like to invite you already to consider the questions you would like to pose to these panelists. And after a first round, where the panelists will make their opening remarks, we will open the floor for questions and answers from the audience. Now, while we are uploading one slide, which will help us navigate the behavioral finance scenery, Darren, to what extent can protection gaps be explained by human behavior? And can these behavioral insights be transported to company or government behavior? Another question, what actually keeps individuals, but also companies or governments, from preventing risks? And what tools are available to incentivize risk prevention? Darren, the floor is yours.
Thank you very much, Pamela. I'm delighted to be here to talk with you today about how we can use some behavioral insights to inform in the context of the insurance markets and protection gaps in particular. So I've been asked to set the scene somewhat and just give a broad general introduction to behavioral economics and behavioral finance. I'll use those terms interchangeably. So very simply then, behavioral economics is about putting the human back into decision making. This is something that from a theoretical perspective has been missing in much of the economic modeling of decision making for a number of decades. But with the innovation of behavioral economics and behavioral finance, starting from around the 60s and 70s, when we've had much inputs into economic theory from psychology, we've started to recognize then that humans, of course, react and behave very differently to what we have been theorizing the Homo economicus decision-making process looks like. So we need to recognize then that humans very much succumb to cognitive biases. They employ simple heuristics such as rules of thumb. They're influenced by extraneous factors such as mood and emotions, and all of these come together to influence the way in which people make financial decisions in the context of insurance, of course, as well, but more broadly. So just to give you some flavor of what the behavioral literature tells us then, just some classic examples that we know that choice architecture plays a key role in influencing individuals' behaviors. Classic examples in this context then are default effects. We've got a great deal of evidence then that tells us that the way in which we set up a choice, so we manipulate the choice architecture, how we set up that choice influences decision making. And defaults have been used then in many contexts, for example, in the context of donor cards and the adoption of donor cards, simply by manipulating the default to be either opted in or opted out, that influences people's behaviors. That's also been something that's looked at in the context of pensions. This is something you've touched on already here today, and the importance of the pension gap. So in the UK setting, we've introduced auto-enrollment, and that's basically looking at the literature on defaults and using that as a way of encouraging people to save for retirement. Another classic example, particularly relevant for today's topic then, is framing effects. We know that the way in which people are given information, even when that information is pretty much identical, but it's simply framed in a different way, and I'm thinking here in the context of gains and losses, then that influences people's decision making. So we have classic examples from Kahneman and Tversky's work in the context of lives saved versus lives lost, and that switches people's risk preferences. What that tells us then is that preferences are not necessarily stable. They are in fact constructed on the fly. and that the way in which we present information influences people's preferences and subsequently their decisions, therefore. In the context of mood, of course, is an incidental emotion. It's something that's outside of the decision task. It shouldn't have any influence on behavior if we're adopting a consequentialist framework when we're looking at decisions purely from the perspective of what the outcomes will be and how they will, what the consequences will be for the individual. Then mood should have no role to play. But we know from a wealth of research in consumer behavior in particular that mood matters. Marketeers have long known that the power of mood can influence behavior. And we have examples in supermarkets, for example, where the smell of bread, freshly baked bread, has been pumped to the front of the store simply to influence people's behavior. Selling a house, the key tip from real estate individuals is have a pot of coffee bubbling away. That smell, that welcoming smell, switches people's moods, changes behavior. We've seen this in the financial markets. We know that in the context of investors and stock markets, they're influenced by the weather. On sunny days, they have more risk appetite. That impacts on risk-return relationships. Sporting events have been shown to influence behavior as well. Simply the fact that the national team has been knocked out of a major national competition depresses society. That feeds through into investor behavior in financial markets. So there's a wealth of evidence then that moods influence behavior. And this is something that from a consequentialist framework, from rational economic perspective, that simply shouldn't happen. People should be making decisions irrespective of their moods. So this is a general setting. Just like to talk very briefly about some of my own work in the context of biases, heuristics, and so forth. I have worked in behavioral finance now for many decades, looking at how people make investment decisions, but more broadly than that, looking also at household decisions. In the context of financial markets, then, there's a cognitive bias known as the disposition effect. This is where people tend to sell their winning shares rather than their losing shares. And unless we believe in mean reversion, this is an error. People do it all the time, not just individual investors, not just the retail investors, but actual fund managers make these cognitive mistakes. Why? Because they're influenced by prior outcomes. And again, in a consequentialist framework, when we're forward looking, these prior outcomes shouldn't impact on behavior, but they do because they change reference points. They change the way in which people think. In some work, then, I've shown that the disposition effect has been highly prevalent in individual trading accounts. I've then gone on to look at how emotions influence the disposition effect. And it's been shown then that emotions play a key role in switching on or off the tendency to succumb to the disposition effect. And that has real consequences for financial wealth. If people sell the wrong shares, of course, their wealth takes a hit. In the context of pensions, I've undertaken some work looking at why people have negative attitudes towards annuities. And we've looked at contrasting defined benefit and defined contribution schemes and looking at the key reasons people don't wish to annuitize within the context of a defined contribution scheme. And one of the key things we've found there then is that the defined contribution scheme makes salient this decision at which you need to convert this pension pot, hopefully a large pension pot, but what we've heard already today is that that's not necessarily the case for many individuals. But even when the pension pot is large, people resist converting that into an annuity because that salient decision that was masked in a defined benefit scheme now comes to the fore, and people resist then that conversion to a stream of future income. So that's a general introduction to behavioral finance, behavioral economics. Why is that important in the context of insurance and protection gaps? Well, because markets are about supply side and demand side. It's about the two coming together. And we can't, therefore, ignore consumer behavior. The demand side clearly has an important role to play in markets, and the supply side, the insurance sector, must recognize then how consumers behave and how they can be informed or helped to make better, more informed decisions. Regulation also has a role to play. And in the context of the insurance industry, then, it's not enough to simply look at the firms themselves and how they're behaving, thinking here in terms of responsibility, notions of trust. It's important also to look at how the firm behavior impacts on consumers. So we know that firms are well savvy to behavioral insights. They exploit these insights in order to encourage consumers to buy their products. And so it's important then that we have regulation in place that has the consumer's best interests at heart. Moving now to think in terms of how protection gaps can be closed using behavioral insights, there's some important key areas here. I'm thinking in the context of risk perception in particular. Consumers' perception of risk then differs very widely from person to person, from context to context, and it differs from what objective measures may be adopted within either theory or within industry itself. So particular examples from some of my own work in the context of investment decisions, we know that from a finance theory, risk is all about volatility, dispersion of returns. Some of my own work, however, shows that people don't think in those terms, and that actually there are instances when they want dispersion, they want to have the chance to get out of a loss position into a gain position, and they want to avoid therefore locking in losses. So losses then are very important when it comes to people's risk perceptions. In the context of the pension market, again, if we just come back to that key example we talked about earlier, then we know that annuities can be conceived as effectively a gamble. You're converting your pension pot into a stream of future income, but you don't know your longevity. And that then, in some academic work, has been looked at in the context of a gamble decision. If that's the case, then people now might start to succumb to such things as loss aversion. So again, work by Kahneman and Tversky in the context of prospect theory tells us that people are highly loss averse, and that influences their behavior. And so we might need to think about how annuities are posed or framed as products. In the context of climate risks and other areas, then we also want to think about how we incentivize individuals to act. Here I'm thinking in terms of temporal or social distance to events. Now there's much literature on construal theory that tells us that the distance from the event that people feel influences their behaviors. Now in some of the work in the UKRI Living Deltas Hub that I'm a member of, we're looking at, in the context of a risk-risk trade-off framework, we're looking at how people perceive and trade off risk, say for example climate risk, with other risk in the context perhaps of road traffic accidents. And we're looking at how construal actually helps us to understand these differences in risk. And what we find then is that people who feel closer to climate risk, and I don't mean physically, but literally in the context of psychological distance, those that feel closer have a higher trade-off when it comes to the risk of climate fatalities compared to road traffic fatalities. So there's much to explore in this area. In the context of choice architecture, then, we've talked about defaults and pensions, the work of the Department for Work and Pension in auto-enrollment, the use of Save More Tomorrow scenarios, talking about the work from Bernarzi and Thaler. And then we also, coming back to annuities, we see evidence in the literature again about framing effects. If annuities can be framed more talking about the consumption side of things, money that can be spent, rather than thinking about annuities as an investment, then we know from the literature, people think very differently. And then in terms of one final point, I think we need to think about how we unpack the risks. There's evidence in the literature that tells us that the way in which we unpack different components of the risk and the probabilities associated with those components very much influences people's risk perception and therefore influences their preferences and their behaviors. Thank you very much, Pamela.
Thank you very much, Darren. And I think you've really managed to set the frame, as to use a term, of the behavioral finance. So I would like to immediately go to Monique. Monique, from a consumer perspective, now, can you tell us what actually drives consumers or people to buy insurance, and what prevents them from buying? And what would you recommend to actually reduce protection gaps?
Yes, good morning to all. I'm also delighted to be part of this panel, and I can only confirm everything that Darren has said about how people are. And I very often say I'm a consumer representative. And what I have learned over the years that I have been working as a consumer representative is that you need to work with the people like they are and not like you would like them to be. And it's very important. You will not change the people because it's billions of people that you would need to change if you want to. So you need to make it easier for them to adapt some of the behaviors that Darren was talking about. And there, of course, use of behavioral science is very useful. And it would be also because when we see financial regulation, not only in insurance, but in all aspects, it's so much focused from the consumer perspective on information and education. You won't get there. Just throwing information at consumers will not help them take the right decisions if you don't understand how they think and how they make choices and how they act. I mean, because there is a difference between thinking and acting. And it's really important there to make that step if you really want to address the protection gaps that have been mentioned several times. Now, to answer your question, why do people buy insurance? First of all, because they're obliged. Car insurance, you don't have the choice. Or because the insurance is covering incidents that they identify as being potentially exposed to, and they want to be covered. Like, for example, family insurance when your kid is doing something wrong or your dog is ruining your neighbor's garden. So this is the type of insurance that they want to be protected against. And then also there are, of course, also artificial needs that are being created, and I would like to highlight that there is a lot of aggressive marketing. Not necessarily by what I would call the institutional insurance companies, but by some other types of insurers who try to get, can I say, money out of people. For example, no snow for your ski holidays, your mobile phone is being stolen, or what have you. And in fact, on the content, on the substance, yes, why not? But when you look at those insurance contracts, they are so restrictive that at the end of the day, you pay a little bit of money, but there is a multiplication of small contracts that in fact makes a big part of your household budget at the end, and you are not covered for most of the situations that you think you are covered, because it's also only small print that indicates all the restrictions. We have the tendency to say that it's small insurance, but it's a big nuisance, and our members have really made several tests to indicate that those contracts have very bad value for the money. So if you could already clean the market with all this useless insurance, that would already clear up some budget in order to help people, concentrate, focus on the insurance they really need. And I totally agree with you that there is a protection gap that needs to be filled. Now, why don't they take insurance? That has already been mentioned by Darren. Of course, there is procrastination. I have 3 kids in their 30s, early family life. They don't have any idea that they need to save for their pension. They are trying to educate their kids. They are trying to get a house or an apartment. And so they say, we will do it later. No, it's now that you need to do it. So this procrastination bias is certainly something that needs to be taken into account. Also, they sometimes just believe they are covered. They think that their home insurance might cover natural disasters. Might to some extent cover, but certainly not the 100% that might be needed. Depends on the insurance company. They also sometimes believe that somebody else is taking care of them. The pension gap, for example. So how many people think that their legal pension will be enough in some countries? Or how many people think that if there is a disaster and my house is going to be flooded, the state or the municipality will help? Well, I'm living in Belgium. I can tell you they don't help, or just a very tiny part. And 1 year after the flooding in east of Belgium, many people still have not recovered the hope. Or they just believe, and that's a huge bias, I don't know how you call it, Darren, that it won't happen to them, or they hope that it won't happen to them. We all are in cyber risk, but we always think, let's say, we do like this and say it won't happen to us. Somebody has taken care of our protection. So there are quite a lot of protection gaps as have been identified and need to be tackled. And what I would like really to insist on is that it's a systemic risk. It's not only, be it pension gaps, be it climate disaster gaps. If you cannot tackle those in terms of coverage, it's not only coverage, it's not only the individual consumers that are being hurt, but it's the economy as a whole, because there will be a real major problem there. And there, we need a systemic approach. It's a systemic risk. We need a systemic approach. And that's why you need to go beyond information and education of consumers. You cannot have it relied on individual choices by the people. And if there is a systemic challenge, you need to adapt the offer, not the people, not the consumer. So there are several tricks already mentioned that can be used. And there is a very, like a default integration into a pension product by the employer, something like that. So there are several tricks that should be used in order to get the people to take on that insurance, and also make products less complex. They are so complicated to understand that people sometimes just think they are covered while they are not. And there is also a lot of what I would call artificial product diversification. And so you have an illusion of choice as a consumer, but at the end of the day, no. So more standardized product proposals, more simple products, at least in the way they are being proposed to the consumer, would certainly help people taking easier decisions. And I would, in that aspect, I would totally agree with Darren. Optimize the insights of behavioral science in order to get people to act by making, by nudging them into insurance products that will help them being better protected when those incidents end up happening to them. That's all I wanted to say at this stage. Thank you.
Thank you very much, Monique. That's plenty we can work on. And I think I would like to now turn to the industry. So in the past years, we've been identifying more protection gaps. Is it because they're growing, or are we just more perceptive of the risks? And Michaela, turning to you, are we now really in a changing risk environment, and how is this affecting the insurance industry's business strategy and also your corporate behavior? So are you listening, and are you seeing the consumers as they are, not as you want them to be, and are you aiming to address some types or some sorts of these gaps and incentivize prevention? Over to you, Michaela.
Well, thank you very much also for the invitation. Listening to Monique, I was thinking there are so many things that I think, Monique, you would be surprised I would agree with, but I come to that in a minute. Yes, we are living certainly in a world where we identify more and more protection gaps. And as insurers, we have over the past years, decades, managed to increase insurability. But now, from our perspective, it also feels a little bit like we are at the crossroads. Yeah, we have, with the increase in digitalization, cyber risks that are coming up, and they are largely uncovered, uninsured. When you look in the past, just now with the pandemic, we went through also these discussions. I had long discussions also with Stephanie on non-damage business interruption, huge systemic risk, that is largely uninsurable. We had similar discussions when we had the attacks in Brussels on terror. So we have obviously a number of risks, and we are living in an ever also riskier environment, and these risks are growing. Climate change was mentioned. We have more severe events and also more frequent events, and again, risks increasing. Now, from an industry perspective, I think the very important statement that I need to make first and foremost is that the industry is super keen on providing cover and to continue to, increase insurability to the best of our efforts. And then, of course, we come to the points that both Darren and us mentioned, and Monique also highlighted. What can we do to close these gaps, especially when we now are thinking about the retail client? And I think from our perspective, we cannot look at behavioral aspects in isolation. Monique has mentioned, I think, the same. There are many factors that play a role. And for me, it starts also when I look at the regulatory framework. The insurance sector is one of the most regulated sectors, I think, in the economy. And, do we have a prudential framework? We are very proud of Solvency II, but does Solvency II allow us to really offer the broad range of products? We have heard about the pension issue. We know from experience that, and also we have surveys undertaken, we know that especially vulnerable groups, female, would tend to save more if they would get a certain level of protection. But we have moved away from, offering guarantees. And I'm not, let me be very clear, we are not, nobody wants to go back to offering 4% guarantees, but they are forms of guarantees that could be valuable today at this day and age. But we are shifting now to unit-linked and putting risks on individual consumers. Is this the right approach? So we need to look at the prudential framework, and the Solvency II review is certainly an opportunity. Then we need to look at the conduct framework. Do we give the right information? Monique has mentioned, we are drowning people in a lot of information. There is a lot of duplicative information. But the information that certainly also during the pandemic was highlighted as absolute key, namely your cover, what is really covered, what is excluded. This is, when you look at the current framework, there is no space literally for the industry to explain cover. And that needs to be addressed really urgently. And I'm grateful that Petra has mentioned it in her introductory remarks. This is an issue. I think also, Monique, then we could manage to get what you call, the artificial need products very quickly out of the market, because as soon as you have transparency on cover, then these very niche products that are certainly not representative of the large offer that is provided, they could be identified much more easily. Also, one point I would like to raise is, do we give the information in the right format? Right now we have consumers that are approaching companies increasingly in a digital way. When we now respond, we have to ask them to come back 3 times to us with follow-up questions before we can actually engage with them digitally. This is definitely also not helpful. So again, we have a regulatory framework as it currently is that is more hindering than helpful. And I know you had originally invited Andreas Brandstetter, our president, and in preparation for this panel, I had this discussion with him. How do you see it as a CEO? What is your challenge? And he said, when we are looking at new products and how can we do something meaningful for the consumers, I have my product team that comes in and says, we have this great idea, we could do it in, explain the cover in a very simple term and make it easy for customers to understand. And then he said, I need to bring in the compliance officer to ask whether this is all possible. And when I look at 10 cases where I have ideas from the product team, I have to lean to say no because of the compliance intervention in 8 cases. So if this is the situation, I think we need to look seriously at how can we also improve the regulatory framework to make these behavioral, intelligent steps that Darren has described and Monique has requested a reality. And maybe I stop here.
Thank you very much, Michaela. And I think there are a lot of regulatory challenges, but there's also maybe an opportunity to explain better what's the product and ask the consumer, do you really need it? Now, moving on to Stephanie, from a political perspective. So we've heard in the introduction from Darren also about risk perception, and we see that there may be some temporal or social distance to how risks are perceived. So what is, in your view, a good modus operandi between regulators, between governments and industry to actually improve on risk perception also for consumers, and what has worked so far in the regulatory regime and what could be improved. Stephanie, the floor is yours.
Thank you very much. Good morning, everybody. Let me first thank IOPA for organizing such a timely conference and for its hard work on insurance regulation over the years, and I'm delighted to be here. I say timely because, as you know, we've just started, and Michaela told a bit on that. We have just started our work on the review of the Solvency II framework in the European Parliament, for which I'm responsible for and as a rapporteur in my political group Renew. And as Michaela just pointed out, I think Solvency II is an opportunity to discuss this crucial point, thinking about the impact behavior it can have on financial decision is definitely critical for a regulator because of the increasingly uncertain world we live in. We are, as most of the speakers and Darren also and Monica highlighted, that we are confronted at the moment with the many challenges, such as the tragedy of the war in Ukraine, the long-lasting COVID pandemic, which is still undergoing, the rising inflation and interest rates, and a number of rising risks related to climate, and of course the environments or cyber threats, for example. And this is why more than ever we need to think of the best solutions to kind of mitigate those risks and make sure that policyholders are protected, of course, and more importantly, feel protected. And Monique, raised this question of feeling protected, and this should be based on the trust and the dialogue they have with their insurance providers. Addressing risk perception means also ensuring that in the system we regulate, each party is planning its role to make sure we live in a society that does protect everyone that needs it with the right level of protection. The question is, what is the right level of protection? And overall, I believe today's topic reflects what good policy making is about, striking the right balance between a number of objectives, sometimes contradicting one another. We also, I think, need to address the concerns and the needs of the different parties on the market, being the consumers, of course, the various insurance providers, but also the 27 EU member states and their national supervisory or resolution authorities. And so far, I think the Solvency II framework has proven its strength over the challenging times we have been through. The insurance sector remained resilient, according to the results of the 2021 stress test performed by IOPA, with a strong level of capitalization evidenced by a solvency ratio of 270.9% at the end of 2020. But that being said, of course, the world has changed a lot since the introduction of the revised directive more than 5 years ago. And, with the long terms, risk I have mentioned, I think we are confronted more than ever with what we have observed in the case of COVID crisis. For example, the question mark about the assurability over time of this risk and the protection gaps this conference is about. And the objective of the current revision of the Directive 2, Solvency II, is to improve the framework, to unleash additional capacities of the sector to finance long-term projects and to contribute also to the European goals of the Green Deal and of the Capital Markets Union, while, of course, at the same time, preserving financial stability and ensuring the strength and competitiveness of the insurance sector. So all these objectives together, and building on these lessons from the COVID pandemic, because I think we need to build on these lessons, we will look at how the sector can cover a number of rising risks, being climate or cyber. And this is why I think the proposal of the European Commission introduces new macroprudential measures to take into account systemic risk, as well as measures, to make sure insurers integrate in their own risk assessments the impacts of climate change. And we will also look at, in this Solvency II review, at how to improve the supervision of insurance activities in the Union, especially in the context of cross-border activities, rising cross-border activities, and looking at the power of IOPA should have. Looking at other powers IOPA actually currently has, and what it should have as well. And in a nutshell, I think that evidence shows that Solvency II framework has proven to be an effective tool after the financial crisis, but we do need to kind of tailor it to the new realities of our world. The question of long-term savings and their ability to channel long-term investments in the real economy is, I think, definitely part of our reflections, and it's also part of our objective to make a tailored regulatory framework adapted to the specificities of the insurance activities and their long-term nature. So in this exercise, to make sure that at the end we get a better regulation, more risk-based and adapted to the world of today, I think we need to listen to everybody. We should try to refrain from working in silos, the political part, the regulation part, the consumer part, no, all together and onboard all point of views. And I think this is why today's panel and conference is so crucial and important. So thanks to IOPA. And as I've already told to IOPA, unfortunately, I have to switch to another meeting at 12, so I won't be able to carry on with you. But if there are any questions you'd like to flag to me, then do not hesitate to send them to me, and I'll be very happy to answer them. And thank you again, IOPA, for this very important and crucial topic of today.
The point is maybe that strong regulation and supervision really helps citizens to feel protected, and there are many ways to get there, and I'm sure we will discuss some of them. So enjoy the rest of your day, Stephanie. And now I'm opening the floor for discussion among the panelists, but also I'm inviting the audience, so please send your questions through Slido. You have been instructed this morning how it works. They will come to me and I will pass them on to panelists. So please share your questions with us. And there are already a few questions which are appearing. So I think, Monique, you have already addressed it. You say there that there needs to be the right level of information, and I think also Michaela has mentioned it. And many of our initiatives on behavioral finance topics have always aimed at focusing on informing consumers. Now, this has led to more disclosure. What type of information would be needed to address protection gaps? So what would be better information for consumers to address risk perception or choice architecture? And please, Darren, also step in if you see that we need some guidance on these tools. Monique, what are your views?
Well, first of all, I would say information will not close the protection gap. That's for sure. Because, even if information would be simplified, that we are overloaded with information on all sides, because consumers are not silo people. We are not. We are also over informed. Just by the social media, by everything we are living in be it buying food, buying energy, or what have you. So information will not solve, but you can improve information. And what I very much liked what Michaela was saying. I think you can present the coverage that in an insurance contract in a better way. I think you can make it simpler, or you can use choice architecture, guiding the consumer into his decision-making process or her decision-making process. So I think that more content matters, but form matters even more if you want people to understand what they're doing. But let me say, and then if information is not enough, you need to nudge them into the decision-making, but also give them tools. I already mentioned it in my first intervention, like make products simpler, make it more standardized, like the presentation can be standardized, even if the offer is not, so that you can compare more easily, give them unbiased advice. Some people need to be supported in the decision-making. Where can they turn to without being, without the risk of being misled because somebody has an interest in having them sign one contract rather than the other. So it's a whole, system that needs to be guiding consumer choice. So it's better information, simpler information, the availability of comparison tools and of advice, because their situation is specific and it's not a one-size-fits-all market. But then the nudging part is much more important, I think, but that is for Darren to respond. I'm sure he has a lot of tips and tricks to share with us.
Thank you, Monique. Any of the other panelists, would you like to add something to that? So better coverage information. What else?
Yeah, if I may, Darren, would you like to go first?
Go after you, please, Michaela.
Okay, good. So can I pick up on what Monique said? I think really it would make a huge change, if you started a standardized sheet by simply saying, is there cover or not? We are living in a world, Monique, you were saying it, where we compare, an insurance product with a normal pure investment product. And currently, we have a lot of information on different price aspects, on performances aspects, but you have to actually look very hard to find where the information on coverage is buried. But that, for me, when I look at it from a consumer perspective, is the key issue. I need to know, am I covered or am I not covered? So a yes, no at the beginning, would make it very clear to the consumer. And I think, when you think about coverage, of course, then the next step needs to be more detailed. What exactly is this coverage existing or consisting of? We have obviously biometric coverage, we have financial risk coverage, and that needs to be explained. But, to have a very easy and clear-cut information right at the beginning, cover yes or no, and that will already help, I think, more vulnerable groups of the population that are maybe insecure because they have, relatively speaking, when they invest their money, it means so much more. And therefore, to be able to know that at least, the money is safe is something that makes it easier for them to invest. And therefore, this approach, which would be a revolution, I think, but a good one, would really make a difference.
Thank you, Michaela. Darren, I'm sure
In terms of
yeah. Go ahead.
Sorry, in terms of the information, and I agree certainly with Monique then that more information is not going to close gaps. Information overload is very real. People simply can't deal with the level of information. It's important, therefore, to give them the simple information that's key to making the decision. I'm thinking here in terms of, say, for example, investment decisions and saving for retirement. We have the example of Monique's children not saving early enough in their life cycle. Why? Well, there's many reasons, affordability, for example, but there's also behavioral factors. People simply are not aware, potentially, of the notion of compound growth and the fact that just a small amount saved very early really is going to grow and have a great role to play in terms of the pension pot 40 years down the line. And so it's about conveying that simple information in a way that people can grasp that and see that very real. Then in terms of complexity of products that we talked about earlier, sometimes products are so complex and there's so much information that people simply can't assimilate that and make the decision to purchase a product or not. And if they feel it's the risk is really keen for them, they're potentially going to over-purchase on complex products. And that then leads to the problem of crowding out. And they may therefore crowd out other insurance products that they would have been better for them. If they decide that they're going to overspend in one area and then underspend in another area. So I don't think information is the story.
Thank you. So I see indeed better information on coverage would be a revolution. I think that's quite a revolutionary thought in itself. I thought that would be the basics, but indeed it might reduce the expectation gap. Now, if all of this doesn't work, Darren, could you maybe explain a bit? I think Monique mentioned it. If the right information doesn't work, you might want to nudge people. You might want to get them out of their procrastination or improve their perception. Now, how far can you go in nudging citizens, humans, in buying a product? So what are the limits to that? And how can we make sure that citizens aren't gamed or that dark patterns appear in product offers, which may actually limit in the end their freedom of choice?
So I think we see very much that individuals can be nudged, that choice architecture has a very big role to play in people's decision making and their behaviors. And that then brings us, as you rightly point out, to the notions of trust and responsibility that industry and that regulators have. So let's just think in terms of some examples. In the UK context, we had the auto-enrollment for pensions a number of years back. Now, from a societal perspective, that's the right approach, but it might not necessarily be from any given individual's perspective. And this is because people think about the risks and losses involved in different ways. So with some focus group work conducted in conjunction with the Department for Work and Pensions, it became clear that people didn't think about pensions as investment vehicles. They thought them more as saving vehicles, and that there was therefore no risk of the loss of the principal invested. And so therefore we need to be very cautious about how we nudge people. How far do we go with this notion of paternalism? And that's something that the regulators and that the industry really need to grapple with. And then related to that then, we need to be cautious of unintended consequences. So I'm thinking here, for example, in terms of regulators imposing requirements on the industry. Say, for example, in terms of credit cards, there's the minimum payment must be included on the credit card statement. And the intention here is for that to help people pay down the debt that they've borrowed. Now, there's some evidence, however, that people then anchor on that minimum payment. And if that's made salient to them, they tend to then pay less down in terms of the debt. And therefore, in aggregate, there's an underpayment. So we really need to think about how unintended consequences can have a detrimental impact on what we're trying to achieve overall. For example, in context of performance league tables, if those are incentive mechanisms that start to become used in industry and in organizations, and they are in many places, then those can distort behaviors and decision making. So if you have performance league tables where different teams are trying to compete against one another in terms of sales, perhaps, then you're going to have a distortion. If they're in second place, the team, then they're going to take more risk to get to first place. Now, these were incentives mechanisms that were put in place to try and improve things, to try and improve sales, perhaps. But there may be unintended consequences, and we really need to research in particular contexts and in particular environments how people will behave as a result of these nudges or these incentives that are being put into place. It can't just be assumed that these are general behaviors that will be across all contexts. And there needs to be key information, key research to look within specific contexts.
Maybe Michaela, handing over to you on this. So how do you feel about the insurance industry's role in nudging people? How is that being perceived, and how can you act as a trustworthy nudger rather than behaving in dark patterns? Michaela.
Well, first, one clarification on your earlier remark. When I talked about it would be revolutionary to have cover, I talked about regulation. Of course, the insurance industry provides the information, but what is allowed in regulation to display is there. It would be a huge difference. Now, to your question, I think when we look at the insurance sector and nudging, and I had many discussions with Monique, and I think even ongoing discussions with her on, should the industry be allowed to nudge consumers to do the right things? I give you an example. We had this long-standing discussion, Monique, I speak under your control now, around telematics in cars. We know that if you install telematics in cars, that it has an immediate effect because drivers that know they have a telematic in their car installed tend to drive more safely, more carefully. And that has obviously beneficial effects on road safety. We can show the correlation between telematics and the decrease in road safety. But are insurers now allowed to push consumers to do the right thing? You know, this is, and can you link it then with your product offer? That is a discussion that we have. And of course, you can say you have areas where it's probably less critical, this discussion, because when we talk about cars, I can frankly only see benefits. But of course, you can have a similar discussion also in the health area, where, you know, then you have the question, how much can the consumer really influence herself or himself at the end? And this is where we come again to the limits and where we are running reputational risks as an insurance sector. I should also mention that regulators increasingly also tend to turn to the insurance sector and to ask us to nudge, you know, like I'm giving you now the example of greening the economy. There was a lot of interest from regulators to ask the insurance sector for stewardship with their customers. You know, can you not simply not underwrite certain risks any longer that are now considered or proven to be polluting? So we have this discussion on an ongoing basis. And I think the important thing here is to really make sure that we stay with the objectivity as much as possible, and we avoid areas where we essentially, you know, where consumers cannot influence themselves in any shape or form. And that is definitely the limit where the insurance sector should then remain very reserved in nudging.
Thank you, Michaela. Very clear. Monique, so what is your view on that? Any different?
I'm not going to speak at this panel about the privacy implication of telematics, so we keep that for another conversation. But there are many things. I think that the industry could nudge in many ways consumers. Let me speak about the protection gap. You know, those areas where they should be covered and they are not. But there could be like incentives for consumers who take out a house insurance to have like a benefit, a financial benefit, because that's what works among the best. If they invest into energy efficiency, for example, if you have a retrofitted house, you contribute to the climate mitigation, you know, adaptation. So this is the type of things. It's of course a very big picture, but that's the way how you can really get people into moving into more energy, let's say, or climate-friendly attitudes and behaviors. And that can be, the insurance sector is a sector where there are plenty of possibilities because there is a lot of interaction with people, but also in cooperation like private-public partnerships with the government, with the authorities. That can also help. For example, even making maybe some insurance should become mandatory, because then you increase the risk pool and it becomes more affordable. So that could be something that could also be, it's maybe not a nudging, it's really a regulatory intervention, but that could be another way of getting, you know, because the problem is that of affordability very often, and we are in an economic crisis. Huh? There are more and more people who cannot afford this type of insurance because they don't even know how to heat their homes. So it's important to have the affordability element. If we have more and more coverage that needs to be funded by consumers, you need to spend the money for that. And that's why I think having sometimes, to some extent, compulsory insurance for systemic risk might be a good thing in order to make them affordable.
Thank you very much.
Camilla, can I maybe come in just very briefly on your point on property insurance? You know, I can assure you these things are taken into account. Of course, you know, this is now increasingly looked at, but we have also in the past done that already. You know, do you have a stable door? Or do you have a very light door that has an impact on your property insurance? It all basically factors into the pricing ultimately. So everything that consumers do in terms of decreasing the likelihood of risk on the prevention side will definitely play out in the offer.
Thank you. And indeed, that's a key measure. If you reduce losses from the damages that are bound to happen, you can maybe also keep insurance more affordable by investing in prevention. And that's actually what we're trying to discuss. How can you incentivize people to take these prevention measures, either through nudges or better information on the coverage, so that they are not expecting coverage where they don't have coverage. Now, maybe going on to the next question we have, so we speak a lot about the transformative nature of the digital environment. So how much is digitalization, the use of artificial intelligence, actually allowing insurers to offer more simple products and really value-adding products, so not just click away, no snow insurance as we heard, but how can it really improve the value of insurance products? So maybe, Michaela, you have a few words to say there, and we hear the other panelists.
Yeah, I think generally when you look at insurance is the business. At the heart of the business is always data. And the more data you have available, of course, the better you become as an insurer in assessing the risk. And I'm now not speaking, Monique, of necessarily of individual data. You know, I'm speaking really aggregate data sets, anonymized, yet granular enough for the industry to really make the assessment. It's very simple. Let's take the example of cyber. Yeah, we have currently very little cyber incident data available. But what do you do when you make then a cyber protection offer as an insurer? You model the risk. But if you model a risk, then at the end of the day, when we look at the prudential framework, you get risk buffers added because your risk assessment is not based on the real risk. So that turns the product more expensive. We can look at other areas. We are now in a situation where I have sometimes the feeling people seem to detect that insurers are using data. We are doing this for decades, centuries, but now often with the debate around digital or artificial intelligence, all of a sudden the use of data by insurance is discussed as something very controversial almost. But you know, data helps us to price more accurately. The lack of data is making pricing more difficult and driving prices up. And I think what we need to do here is, and what I would welcome is really a very broad debate with the supervisors, with the regulators, with the consumer organizations to really discuss the mechanics of how insurance work and how we can keep insurance affordable. And have this debate, because currently we have a feeling we have many initiatives that are super well-meaning and, where people say, let's, take away the data because we want to protect individual data of the individual citizens and therefore let's rather be careful and not share. But that could have really detrimental side effects. And therefore we need to have a discussion, how can data that then can be anonymized and aggregate and granular still be used to achieve the best outcomes ultimately for the citizens. But for that, we need this engagement and this dialogue.
Monique, I think you can only agree that data has to be safe, but also that in order to keep insurance affordable, some information is needed, right?
Yeah, I mean, I have no problem with AI if it's used as a smart tool. And there is many data that can be processed by the insurance sector in the context of protection gaps that we are addressing now that have nothing to do with individual data or personal data. So what we only say is that keep the personal data safe, as you said, and that is something that might be controversial to some extent in the way it's being used. I'm not saying here by insurers, but it can happen really. But also, you need to keep them under control. AI can be biased and can be ill designed. So you need always some sort of human control of the data, of the results of the data processing. So if that is an element of trust, you cannot totally automatize the whole process. But of course, AI is a tremendous tool for gathering all the information that is needed in order to calculate the risk. Certainly when it comes about weather incidents, for example.
Thank you, Monique. And with this, I would like to ask one question to the audience. And while we are uploading the Slido question, it's one question. What would you recommend now supervisors, regulators do most from here onwards to continue to add value in the discussion on protection gaps? And I'll help you in reading out the potential answers. So either we conduct more risk assessment to identify the gaps. Second, we define measures to actually promote prevention of the risks, to address the behavior. We look more at product design, at disclosure, to see whether products really meet consumer needs, whether they know whether they're covered. And then the two other options, all of the above or none of the above. So I think it is a very small sample, I must say, but maybe people are already looking forward to the lunch break. This is the obvious remark or obvious joke I would make. I think most of you have, from the small sample, have said that we should do all of the above. And I think that's exactly what we're trying to do, but all in a proportionate manner. And let me then end this panel by thanking Michaela, Monique, Stefanie, and of course Darren for helping us navigate this very interesting topic. And we even have a picture to help us remind what we've talked about. So I hope we can be able to share that with you and with the audience. And I'm looking forward to meeting you on another occasion. Have a good day.
Well, thank you so much, Pamela.
Thank you very much.
Very
Bye.
interesting.
Thank you.
Panel.
Thank you.
We are now checking with Sophie, I think, because she has been drawing. We have seen that briefly already in one of these butterfly pictures. She's been drawing a cartoon on the last panel, and perhaps we can enlarge that a little bit so we're able to see that more precisely. Sophie? So I think we have a little bit of a problem there. So we see that she has tried to cover, of course, all these multiple dimensions to the topic. So we have strategic priorities. We need more influence from behavior. Risk perception is different for everyone. Why do people buy insurance? It's, of course, like the general big topic. There are different motivations to do so. There is also, as we are moving on, the need to adapt the offer, which are available according to the individual needs. So you see, Sophie has been addressing has been visualizing, I should say, the debate quite neatly in that picture, which probably takes a bit of time to actually to digest. And talking about that, we'll put those pictures online on IOPA's homepage, and you have a little bit more time to actually look at it and perhaps also think about the implications from all these factors which are important when we are discussing the topic of protection gaps and addressing behavioral change. Pamela was already saying that we're now heading into the lunch break, which is actually happening now for 30 minutes. And we'll be back at 1 o'clock with Victoria Saporta, who is the chair of the International Executive Committee of the International Association of Insurance Supervisors. And we hear her take on as well common risks and of course the state of play of the industry. So thank you very much for joining us this morning, and I hope to see you all back right after 30 minutes lunch break. back. I hope you all had a lovely lunch break wherever you are located. We are moving on, and that with Victoria Saporta. She's chair of the International Executive Committee of the International Association of Insurance Supervisors and executive director of the Prudential Regulation Authority at the Bank of England. So Victoria, the floor is yours. Hi. Hören wir sie oder hören wir nur ich sie nicht? I think.
Can you hear me?
Now we can hear you, yes, indeed.
Excellent.
That's excellent. Hi,
Thank
Victoria.
you.
How are you?
I'm very well. How are you?
And
thank
very
you
well.
for having me here. Good afternoon, friends, colleagues, all. Good morning, good evening. And thanks to Petra and her team for inviting me to speak in this interesting conference. In my remarks today, I will wear two hats: Chair of the Executive Committee of the IAIS and Executive Director of Prudential Policy at the Bank of England. So now let me put my IAS hat on, that is the international global perspective. The current risk landscape is rapidly evolving, given the continuity effects of the COVID pandemic, the war in Ukraine, and the increasingly downbeat global economic outlook. Our current analysis at the IIS of the risks facing the global insurance sector, on which we work with IIS members across Europe, highlights the following global risks. First, there is a limited direct impact on the global insurance sector arising from the war in Ukraine. While certain lines of business, such as aviation, are materially affected, there is limited direct underwriting exposure given low insurance penetration rates in Russia and Ukraine. Second, however, broader macro risks have increased, including inflationary pressures not seen in decades, driven in part at least by supply chain shortages and surges in commodity and food prices. Third, we observe a marked rise in corporate and sovereign yields. Perspectives of growth are being reassessed with potential consequences for credit risk. And if inflationary pressures become stronger than currently expected, that could lead to a further tightening in global financial conditions and the potential for financial market volatility with consequences for market risk. Lastly, we must continue to be alert to cyber risks, especially given the increased extent to which some state actors may use these tools. This places a heightened responsibility on supervisors to ensure that insurers have proper cyber resilience plans in place, and that where they underwrite these risks, they do so in a manner in which the risks are well understood and managed, and exclusions are clearly communicated to policyholders. So while the insurance sector has to date been resilient in aggregate, including to the COVID shock and this extremely unfortunate war in Ukraine, a deterioration in the global economic outlook certainly places further pressures on both the asset and liability sides of the sector. Let me now turn from the immediate to the medium term. The key risks and trends impacting the insurance sector are increasingly global in nature, and it is on these issues that IIS's role is particularly relevant. By way of example, I will briefly touch on the issues of climate change and cyber risk. Our work on climate change is moving forward quickly. We are seized as a community of international supervisors by the importance of tackling the impacts of climate change, which are already evident, also here in the EU. Our analysis to date has concluded that while the insurance core principles are sufficiently broad to cover climate risks, we need to undertake further work. In particular, We will make a limited number of changes to ICP guidance and develop supporting material to make it even more explicit that insurance supervisors should be requiring insurers to incorporate climate-related risks into the day-to-day operations, including in governance, ERM, and disclosure. Second, we are supporting members to address practical challenges within the emerging field of climate scenario analysis. Over the course of the next few months, we will be gathering information on good practices and offering capacity building training across our membership to increase knowledge on these issues. Third, we have added climate data elements to the global monitoring exercise we conduct every year to assess systemic risk in the sector. These elements will become a regular feature of our annual assessment and provide a global baseline of climate risk data for the insurance sector. Early next year, we will also consider whether to collect climate data directly from individual insurers. Cyber is another growing global risk to which we are dedicating additional resource and energy. It will be the special topic of this year's Global Insurance Market report, the GMAR, including how cyber underwriting activities of insurers could mitigate or amplify potential financial stability risks. Additionally, we are developing an issues paper on operational resilience in the insurance sector, specifically on supervisory considerations with respect to risks associated with the IT third-party outsourcing and insurance sector cyber resilience more broadly. The paper will also consider lessons from the pandemic on ensuring business continuity over an extended period. Lastly, but not least, I also want to touch on issues of culture and conduct. This is a growing focus area in insurance supervision at the global level, and I know also in the EU. Our work calls for supervisors to adopt a more integrated approach to prudential and conduct risks, recognizing that conduct risks can lead to financial soundness concerns for the sector and vice versa. Traditional compliance-based approaches to conduct supervision make it hard to ascertain possible risks to customers, especially in the current and emerging insurance landscape. Supervisors are therefore increasingly looking to adopt more forward-looking and outcomes-based approaches to conduct risks. To aid that, next week we will publish a report which presents findings from a survey of IIS members on supervisory approaches and challenges relating to the use of data and key indicators to assess the conduct of insurers. I'm sure many in this audience will be interested in the conclusions. Also, as we enter the third year of the Insurance International Capital Standard monitoring period, the ICS, momentum is growing as we approach the finish line for developing the standard. There is plenty of work ahead, but we remain committed as an international community to achieving shared success in this area. And in terms of our timetable, we remain firmly on track to delivering the ICS as a prescribed capital requirement by the end of 2024. We have also made good progress on preparing for the comparability assessment of the aggregation method with the International Capital Standard. Last week, we launched a consultation on the draft criteria to assess whether the aggregation method provides comparable outcomes to the ICS. The task of designing the comparability assessment is a complex one, given that the ICS and the aggregation method frameworks are methodologically and conceptually quite distinct, and at the IIS we're committed to a technical and robust assessment. Given the complexities and our commitment to a technical and robust assessment, stakeholder feedback is particularly important, including on some of the specific questions around the scenarios we will put through the two approaches and on what constitutes representative samples, in order to provide a range of perspectives on this unprecedented area of work and to gauge views on the appropriateness of the draft criteria to deliver a robust assessment. That's all I had to say from a global perspective. Let me now take off my global hat and let me now put on my Bank of England hat. First, I'd like to say that the current insurance supervisory priorities of the PRA and the Bank of England closely reflect the risk landscape as assessed by the IIS. For example, in a recent annual supervisory priorities letter to insurance firms, we stress the importance of climate risk, operational and cyber risk, and financial resilience in the current economic conditions, all covered in the IIS's risk assessment, and evidence of the way a supervisory activities shape and are shaped by the work of the IIS. Second, as in the EU, the UK government is carrying out its own review of Solvency II with the aim of tailoring the regime to the UK context. The government is reviewing a number of areas, and the resulting reforms are intended to encourage a vibrant and internationally competitive sector, protect policyholders, and support productive finance to underpin long-term growth. Our focus as PRA, the prudential regulator in the UK, is on our statutory objectives of safety and soundness and policyholder protection. And subject to those, we also share the government's other objectives. In April, Her Majesty's Treasury published a consultation paper, and the PRA published a discussion paper alongside it. Between them, these documents set out ideas on reforming the two key areas of the risk margin and fundamental spread, and the government's and the PRA's respective high-level views on the potential impacts of the reforms. We at the PRA have long recognized and argued for the need for reform to the risk margin, which is both too volatile and too high in low-rate environments. And given changes in UK life insurance portfolios, it's also been clear to us that the fundamental spread also needs to reform to reflect the risks that insurance now run on a wider range of investments beyond corporate bonds. It's worth stressing that UK life firms hold a much wider range of assets than EU firms, including making use of internal ratings which are not used in the EU matching adjustment portfolios. At the moment, the deficiencies in the risk margin and fundamental spread partially mitigate one another. Hence, it is important to the PRA that reforms address both with the impacts assessed in aggregate. As you would expect, the UK and EU reforms are each focused on those areas of Solvency II that are of most interest to each of our markets. Clearly, we are mindful of developments overseas, but our review is focused on what we think is right for the UK. For example, risk-free rate extrapolation and standard formula reforms are important to the EU, whereas for the UK, a focus on matching adjustment and internal models makes more sense. We already use a 50-year point curve, market curve. Like the EU, on the risk margin, we see advantages in adopting a similar modified cost of capital approach, although our calibrations are likely to be different. The PRA estimates that the Commission's proposal would result in a 30% reduction in the risk margin if applied to the UK. A reduction of this size is in line with what we think is appropriate for our non-life insurers and would also ensure that the sector remained internationally competitive. For our life insurers, and in particular our annuity writers, we think that a reduction in the risk margin of around 60% could be appropriate, but only if accompanied by the strengthening in the fundamental spread that we believe is also necessary for our market. For the life sector, we assess that the package of reforms the PRA can support would release around 10% to 15% of capital resources under the economic conditions that prevailed in year-end 2020, which is when our impact assessment data was collected. The capital release is assessed when the package is fully implemented and pre-Solvency II transitionals have run off. A key assumption in assessing impact of the reforms is how much reinsurance firms use. Since Solvency II came into force, UK insurers writing annuity business have reinsured offshore almost all of their longevity risk. This is in large part because under its current design, the risk margin makes it very expensive to retain longevity risk. In our impact estimate, we assume that firms' overall mix between reinsured and non-reinsured business remains at current levels. The assumption will therefore vary by firm. This assumption on reinsurance is one which has gained significant focus amongst UK life firms. It has been suggested by some that firms will continue to reinsure offshore very large volumes of longevity risk post-reform, and so the assumption is too low. On the other hand, others have suggested that the assumption is too high, and we should instead assess the impact of the reforms under the assumption that firms did not reinsure at all. This is because policy impacts should be assessed gross of risk and capital management actions. Our view is that we are making the right assumption here. First of all, it reflects firms' current balance sheets rather than making arbitrary assumptions about changes in behavior many years into the future. Second, it would be wrong to assume that current very high reinsurance levels could continue indefinitely after risk margin reform, given the increasing reinsurance credit risk concentrations, which would then build up over time. If assessing the impact in the UK is not straightforward, imagine how not straightforward is the comparison of the impact to the EU reform package itself. So this is a tricky exercise, not least because the two sets of reforms are focusing on different areas which may behave differently in different economic conditions. And I should make clear that it is not our objective to design our reforms to target a particular level of capital release, either for our own sector or in comparison to the EU. We're trying to do the right thing here. That said, assuming similar economic conditions and accounting for relative market size, and given the different issues focused upon by the two types of reform, we estimate that the package of reforms envisaged by the PRA would release a modest amount of extra capital in relative terms than the proposed EU reform package, while continuing to provide adequate policyholder protection. So, with my two hats, I've spoken to you today from the perspective of someone involved with monitoring the risk landscape and environment internationally and promoting international best practice. And as one with responsibilities for making regulation in a single jurisdiction, within that context, I have also spoken to you. Both of these tasks are made much, much easier with the sort of information sharing, relationship building, and cooperation events like this help facilitate. I hope you enjoy the rest of the conference. Thank you.
Thank you a lot, Victoria. Yes, and we are moving on swiftly to talk about new risks. The next panel will be on reflecting new risk into regulatory frameworks, and for that I'll pass it over to the head of policy at EIOPA, Justin Ray. So Justin, the floor is yours.
Thank you very much, Annette, and I'd like to welcome everybody to our second panel discussion. So in this panel we are looking at reflecting new risks into regulatory frameworks. And this, of course, is very relevant to the theme of today's conference of From Uncertainty to Strength. How do our regulatory and supervisory frameworks deal with new challenges such as sustainable finance and cyber? In terms of strength, how do our frameworks recognise the opportunities of these new developments? And it was interesting to hear just now Vicky Saporta cover some of these topics from an international and a UK perspective. I'm delighted to welcome today a very distinguished panel to discuss the new challenges in regulatory frameworks. So firstly, it's my pleasure to introduce Kathleen Bahrain, who is the Insurance Commissioner for the US state of Maryland. She's held that position since May 2020. Prior to her appointment, Commissioner Bahrain was a partner in the Insurance Litigation and Regulatory Practice Group at the law firm of DLA Piper.
Morning.
Thank you. Thank you. Commissioner Bahrain is currently a member of the Executive Committee of the National Association of Insurance Commissioners and chair of its new Innovation, Cybersecurity and Technology Committee. She's also a member of the Steering Committee of the EU-US Insurance Dialogue Project and finally co-chair of the Health Insurance Workstream Special Committee on Race and Insurance. Commissioner Bahrain, you're very welcome. Our second panellist is Didier Millereau, who is head of unit in DG FISMA in the European Commission. Didier has a legal background. He's had a distinguished career in the Commission. He started there in 1994, dealing with international relations in the social field. He was head of unit in financial reporting and accounting, subsequently banking and financial conglomerates, and since April 2019, head of the insurance and pensions unit. Our third panellist is Nienke Brouwer. Dr. Nienke Brouwer is a lawyer since 2011 and also an academic researcher. In June 2022, she joined the international law firm Stibbe in Amsterdam, where she is Senior Associate Cybersecurity, Cyber Insurance and Data Protection. Nienke frequently advises on cybersecurity issues and provides incident response services after cyber incidents such as ransomware attacks. In 2021, Nienke was awarded the national title of Legal Woman of the Year. And our fourth panellist is Connor Donaldson. Connor is the Chief Executive Officer of the Global Asia Insurance Partnership. This is a tripartite partnership between academia, the global insurance industry, and regulators and policymakers to support the future developments and needs of the insurance sector. Climate risk and pandemic risk have been identified as two of the initial focus areas of the GAIP. Before the GAIP, Connor was, as is known to many of you, a member of the senior management team at the International Association of Insurance Supervisors. And by the way, I'm Justin Ray. I'm the head of the policy department here at EIOPA. So in the first round, I will ask each panelist for their views on some new risks. We will have, during that round, one Slido question. We will then have a second round, and I ask those attending the conference, if you have any questions, please submit them via the chat, and we will set aside some time to deal with those at the end. So, let us turn to our panelists, and I'd like to talk first about sustainability, and I'd like to ask Connor the following question. Regulatory requirements, such as capital requirements in Solvency II, are based on evidence from the past as being the best guide to the future. How should we reflect that climate change means that future risks will be different from past risks? Please, Connor, the floor is yours.
No, first, let me just say a big thank you, Justin. It's absolutely an honor to join today, and a big thank you to Petra and the team at EIOPA for organizing this conference. I think you've highlighted what I think is one of the existential challenges when we think about climate risk. I think all of us are very aware of the fact that the physical environment around us is changing, and it's changing quite rapidly. And of course, in this environment of change, it's very difficult to base future assumptions on past data. But I do think that it's important that we recognize that this isn't something that we're going to be able to solve. And I do think that it's important when we think about this that we actually start to think about it more from a consequentialist background, and not to use an obscure philosophical term, but I think it's important that we recognize that what we're trying to do and the consequence that we're trying, or the results that we're trying to achieve, we need to be taking decisions with those results in mind. And so when we think about orienting ourselves towards the future, yes, it's very important that we do have empirical evidence, and we definitely should, of course, as we progress on some of these difficult topics and difficult challenges, that we do, of course, take that empirical data into account. But I think we need to be bold, and we need to be ambitious, and we need to be operating in this space from the perspective of the consequences that we hope to achieve. And that is that we, as financial sector participants, do play the role that we need to play in terms of transition to a net zero economy.
This term has come up in this conference. It was also used by Professor Duxbury in the session on behaviour. Thank you. I'd like now to ask the Slido question. So, and this is going to be on the S of ESG, the social side. So please, audience, get your fingers ready. And the question is, social risks, the S of ESG. How should supervisors reflect this as a new risk? And you can see the different options that supervisors should embrace it as having a part to play in a fair society. Proceed with caution, be prepared to consider it, but needing to be precise on what is meant, or forget it. Supervisors are not social justice warriors, or of course, none of the above. So please, I invite you, the audience, to now vote. We have one vote so far. Up now they're coming. I'll just give it just a little bit longer. Okay, I think we're reaching well, still changing. I think we're starting to reach an equilibrium, however. And what I would conclude from this is that relatively few take the position that supervisors should forget about social risks, that there is a broad balance between those who want to proceed with caution with greater precision and those who think that we should embrace it, with a small majority of those who are saying proceed with caution. If I may go back to you, Connor, please respond to what you've seen there from the audience, and consider, please, what is the best way to include social issues into a prudential framework? Please, over to you.
Thanks, Justin. And I have to admit, I'm not particularly surprised by the results, and I think that there's three reasons for that. So the first one is that I think naturally insurance supervisors operate from the perspective of very much, let's see how things are going to unfold. And what I mean by that is that we're not generally the community that jumps headfirst into something and thinks about trying to make the conclusions afterwards, notwithstanding, of course, the comment that I made around the environmental side. I recognize the contrast there. But I do think that that's one element. I think the second element is that we are entering into a space where it is challenging to differentiate between the values-based element of the social versus the I think more clearly empirical and prudential aspects around the environmental side. Though I would note that, of course, there are tensions on the environmental side as well. I can give a personal anecdote if the opportunity presents itself later, but just to say that I think that the E is more easily quantifiable. And I think then the third element is, whilst I think supervisors have played an important role in terms of recognizing that particularly diversity, inclusion, and equity do have important considerations and an important role in terms of prudential objectives. I think when we move into spaces where we're taking those next steps in terms of understanding what exactly that S and ESG mean, that we do need to have a bit more socialization around the concepts and the elements of what exactly we're talking about, because I think that, for lack of a better term, that shared taxonomy is not really there on all of the S elements yet. Notwithstanding, of course, I think the good progress that's been made, particularly around diversity and the importance of diversity, particularly at the senior management and board level. And I think that there is a recognition that there is prudential outcomes that are supported by having greater diversity. So that would be my perspective on the responses that we saw. And I think ultimately, looking ahead, many of the values elements within the ESG component, these really do require continued conversation within those political constituencies that supervisors operate within. I don't think it's up to the supervisor to try to lead the political and policy discussions around some of these topics, but I think it's an important actor within the discussions. And I think ultimately recognizing that there are steps that the supervisor can take that are aligned with its conduct and prudential objectives, where that S element of ESG are important, and ultimately where they can take a clear stand in terms of this is the conversation and the nature of the conversations within our political constituencies and the environment that we operate in, and this is how we can make sure that our prudential and conduct objectives are well benchmarked to the importance that society and the political communities at large are putting on this topic. So, from my perspective, it's going to be an ongoing dialogue, an ongoing discussion, but I think one where supervisors have been playing an important role, and I think have been helping to advance the conversations, particularly as they relate to the financial sector and the insurance sector in particular.
Thank you, Connor. I recognize much of what you say. I mean, particularly when you refer to supervisors on the whole not making discontinuous leaps. And I think that partly reflects our desire to use evidence where possible, and evidence tends to proceed incrementally rather than in sudden jumps. And of course, the point you also make about it's not usually the role of supervisors to take a political lead. I'd like to build on one aspect that you mentioned in your response, that of inclusion and diversity. And I'd like, please, to ask Kathleen a couple of questions. Firstly, Kathleen, should supervisors care about inclusion and diversity despite being supervisors, or precisely because they are supervisors? Is inclusion and diversity a prudential issue?
So interesting, and thank you for that question, and thank you for including me on today's panel. I'm excited to join from the U.S. state of Idaho, where the U.S. commissioners are all gathering. Today's the first day of our mid-year roundtable, and I can assure you that many of the issues we are discussing today are front and center on our agenda here as well. So your question is interesting because it uses the word care. Is caring about diversity and inclusion within the scope of our remit as insurance regulators concerned primarily, although not exclusively, with the fiscal soundness of the insurers that we regulate? And I would say that as regulators, we have a broad statutory obligation to ensure that the financial stability and solvency of the insurance industry, and to protect the rights and interests of policyholders, as well as assuring a stable and reliable insurance market for the protection of society. And therefore, I would say unequivocally that because we are insurance regulators, we must care about diversity and inclusion, because a company's DEI practices relate directly to a company's economic and market performance. And there's probably no area that makes that clearer than with respect to AI and the use of AI, and more specifically machine learning, to develop and drive digital decision-making. The risk of unfair discrimination that can result from algorithmic bias within such systems, which bias itself can result from the absence of diversity among the architects of those systems. And that's just one very important, but just one example. So as regulators, we know how important diversity and inclusion are in assuring fair outcomes, in assuring viable product design, in ensuring a pipeline of talent, in assuring that the company keeps pace with the demands of the society and the market in which it operates. And so we must care and we must be thought leaders in this area. And the NAIC, the National Association of Insurance Commissioners, has certainly filled that charge in the establishment of the Special Committee on Race and Insurance in 2020. The mission of the committee is to serve as the NAIC's coordinating body on identifying issues related to race, diversity, and inclusion within the insurance sector, as well as in access to the insurance sector and insurance products. And the committee includes two specific work streams that are devoted to DEI in insurance, both with respect to improving DEI initiatives within regulatory agencies and working with industry to escalate those same kinds of initiatives in the private sector and promoting that. And of course, the NAIC has been very active in promoting that same work at the AIS. In the NAIC's recent spring national meeting, we launched a foundation to fund college education, internships, and apprenticeships for diverse individuals seeking careers in insurance. And I would say that in some ways that action is what exemplifies, I think, what is always the underlying question here. So when we talk about what it is that regulators should be concerned about, I think the underlying question is always, how do we express that concern? So specifically, what is the role of the regulator when it comes to the DEI practices of the companies that we regulate? And in that regard, I would say that this is an area that lends itself, at this point at least, primarily to understanding and tracking industry activity, and then collaboration and partnership. It is not, in my view, and probably very consistent with the Slido result and with some of Connor's statements and your statements, Justin, a place for us to jump into, very specific regulatory requirements and practices. I think at this time, it is probably at most and at best a set of regulatory expectations in this area. So what is it that we expect companies to be doing, how to be appropriately and actively engaged? And honestly, I will tell you, at least my own experience with US companies, that is where companies are. And that is where the US industry is.
Thank you very much, Kathleen. And I would take from that response that you are very much in the camp that supervisors should care about inclusion and diversity because they are supervisors. That, as you put it, that you see a clear link between diversity and inclusion and wider performance. It was very interesting to hear about various initiatives in the US in this space. And if I may follow up, I mean, if we accept that diversity and inclusion is an important issue for insurers and for pension funds, what would you say would be the most important area of focus for them? Would it be in their management, or in their investments, or in the products that they offer? Thank you, Kathleen. Back to you.
So that's hard because I want to say all of the above. There really cannot be, a hierarchy of areas of focus on inclusion and diversity for insurers. The concepts should be considered throughout all component parts of the insurance value chain and across all divisions and operations of an insurer. So, however, there is always a place to start. And so therefore, from my perspective, I would say the most important focus has to be at the top as part of the organization's strategic objectives. I read this amazing quote the other day on LinkedIn of all places, but I think that it's really true. And the quote was that, to make sure that I get it right, diversity means that you ask the right questions. Inclusion means that you get the right answers. So isn't that perfect? Because for their own sake, companies really need to see diversity as a business imperative. So we know that companies with above average ethnic, cultural, and gender diversity in their executive teams are more likely to experience above average profitability than peer companies. Diverse leadership is more likely to take advantage of crucial market opportunities, as inherently diverse contributors understand the unmet needs in underleveraged markets. Diversity drives innovation. People with different backgrounds and experiences can see the same problem in different ways and come up with different solutions. And diversity leads to better risk management. It leads to larger talent pools and employee satisfaction. So ideally, companies that are focused on diversifying are looking at their boards and their executive teams and their senior management, which then will drive diversity inclusion in all of the other key areas of strategic importance to that company, including good product design and including investment strategies. So say we start with management, but they're all really important.
Thank you so much, Kathleen. And clearly you don't see inclusion and diversity as a trade-off, but actually an enhancement of performance. I mean, that is a very interesting perspective. Thank you again. I'd like to look at a challenge we've all just faced and which has already been mentioned many times in this conference, that of the pandemic. And I'd like first to ask Connor whether the pandemic showed that prudential regulation sometimes misses the big picture, that the impact of the recent pandemic on insurers was perhaps less than might have been expected. From the perspective of supervisors, should they be concerned about that what is perhaps good for balance sheets may not be so good for society? Please, Connor, over to you.
So the quick answer, Justin, is yes. And the reason for that, GIP, the Global Asia Insurance Partnership, we've identified pandemic as one of the core thematic focus areas for our organization. And I think we recognize that, of course, there was a lot of economic and social harms associated with the pandemic, not least, of course, the very unfortunate impact that it had on human life. And I think what's been so challenging with it, though, is that the insurance sector, I think, faced a very challenging environment and one where, of course, they were in a situation where, as the cliche goes, you're damned if you do and you're damned if you don't. And I would say with that, yes, I understand, but I do worry because I think in the eyes of many policyholders, potential policyholders, unfortunately, I think that the pandemic was viewed as an insurable event. But I think that when we think about that, it's not insurance in the typical way that all of us look at it. It's actually the worst form of insurance, which is basically that the government was there as an insurer and the premiums are paid in future obligations of taxpayers. And that is unfortunately, I think, a bad recipe for the long-term health of the insurance industry. And so I do think that it's important that supervisors recognize that, one, yes, prudential considerations, and in particular, making sure that firms remain in a position to be able to continue to meet the obligations that they have to policyholders. And absolutely, insurance companies should not be providing payouts for risks that they never underwrote. That's not it. But I think that we have to be very mindful and very careful, and it's probably a very nuanced role that the supervisor has to play in terms of the vociferousness at which insurance executives fought claims related to the pandemic. I think the risk is that is a memory that's going to stick with policyholders for a while, but also it's going to stick with policymakers as well. And so when we think about the impact that could have on the insurance sector, and particularly as we look on the horizon at some of the emerging and accelerating risks and the importance of having public-private collaboration in terms of addressing them, I think we need to recognize that there is probably some work that needs to be done on the part of the sector to rebuild some of that social capital that it had and to help contribute to strengthening that trust quotient between policyholders and the sector. I'm not trying to be overly provocative, but at least from where I sit, this is how I'm looking at it at the moment, Justin.
Thank you so much, Connor. The worst form of insurance, the importance of public-private partnerships. Maybe I should ask Didier, please, whether there's anything you wanted to add on this question about pandemic and the risk of it missing the big picture from the perspective of the European Commission. Please, Didier.
Thank you very much, Justin.
Has he gone?
It is on mute.
Sorry, this is a freshman mistake, not properly press on the button. Apologies for that. I was thanking you all for inviting me and welcoming all the participants. But no, I will try to answer the question. It's not the easiest question you asked me to start with, obviously, but I think I can largely concur with what Connor said. First point maybe I'd like to underline is that in Europe, the pandemic was first a test for the prudential framework and probably quite a successful one. We felt the benefit of having a robust and demanding prudential framework at the time, thanks to Solvency II, so that the insurance industry was able to withstand the impact of the economic downturn and absorb the losses, and actually coming out of the crisis in quite a good shape. Of course, a lot can be said about the contribution of macroeconomic policies in this context, but the two together, I think, made that we managed to come through the crisis in quite a, let's say, in a good way. Now, on the second point, which Connor also underlined, the impact of this on the perception of what the insurance industry can do and cannot do. I think we all realize indeed that applying traditional insurance solutions to events of the magnitude which we have lived, where you have decrease in GDP in terms of many percent points, is something which probably is impossible. It's true that some people thought that they were covered. So there was also an issue of, let's say, the level of transparency, clarity of the terms of the policies towards policy holders, probably a lesson we should draw from it. We should ensure that for the future, when there are exclusion clauses, these are absolutely, let's say, known to all policyholders, and there's no trick in terms of trying to hiding that. We should avoid litigation in this respect, like we have seen sometimes in some country after the pandemics. But we should also try and think more long term. It remains a big challenge. There are examples of, let's say, climate risks which are of a smaller scale, which are concerning a more limited amount of people with a more limited geographical scope, which probably can still be dealt with through insurance solutions. And by the way, we are going to open a discussion with our colleagues in DG Clima in the next month to discuss the issue of the climate protection gap. And there are examples at national level that prove that insurance solutions can still be applied in such cases. But of course, this may come often with the need to increase premiums and also perhaps sometimes lead to compulsory insurance to make sure that everybody contributes so that you can have indeed this diversification or mutualization effect, which you need to ensure a proper insurance solution. But for the big events, for the big ones, it's very difficult. We have explored the possibility to do this public-partner partnership. The debate is still on, the jury is still out. The difficulty is that at the end of the day, it's often the fact that the bill is sent to the public authorities, as you said. So the actual, let's say, contribution or added value of insurance in this respect, in these very specific situations, in my view, will still need to be established. So this would be my reaction to the question, Justin. Thank you for asking me my views.
Well, thank you, Didier, and very interesting. And there's a question about who suffers the pain or how the pain is shared in something like the pandemic is clearly a very live issue. Ninka, you have been very patient, for which I thank you, but I'd like to turn now to cyber risk and ask you, please, what steps is the insurance sector taking with regard to cybersecurity? Has the pandemic, which we've just been talking about, and cross-sectoral regulation led to an acceleration in the resources, policies and infrastructure devoted to cybersecurity. Please, Ninka, the floor is yours.
Thank you, Justin, and thank you for inviting me for this panel. It's an honor to be here. Concerning to cybersecurity and cyber risks for the insurance industry, I think the risk is twofold. Of course, for the cyber insurance industry, there's the risk of large financial losses as a result of coverage for cyber incidents and cyber damages. And the second aspect of cyber risks and cybersecurity for the insurance industry is insurance companies being a potential target themselves for cyber attacks. So with regard to the first aspect of cybersecurity or cyber risks, the steps that have been taken, let me give you two examples. There is the aspect of tackling the risk of silent cyber or non-affirmative cyber, which is coverage for cyber damages under traditional insurance policies like property policies or casualty policies. While this coverage is not explicitly included or excluded, and the risk, the cyber risk, was not part of the pricing and underwriting process. This is a risk for the insurance industry because this may affect the financial stability in extreme cases. And this has to do with the nature of cyber risk, obviously. Cyber risks are a little bit different, I think, from traditional risks like a fire risk or flooding or something like that. Cyber risks are highly interdependent. They are hard to I can't find a word, but they are interdependent and they depend on developing technologies. They are cumulative and potentially catastrophic because of the systemic nature of the risk. So this is why silent cyber or non-affirmative cyber has been addressed by, for instance, the PRA in the UK as a major risk for the insurance industry. So the PRA has given several calls to action to the insurance industry, which has been followed by Lloyd's of London in 2019, which gave the instruction to the insurance industry to have an active management for non-affirmative cyber and to provide clarity in all the traditional policies and lines of business about the coverage for this risk. So after that, great efforts have been made by insurance companies to tackle this non-affirmative risk and to make it affirmative. And the result of that is that broad exclusions are being used at the moment on traditional policies, which cause other problems, I think. There's some uncertainty about the scope of this coverage, about gaps between the different policies, gaps between traditional policies and standalone cyber insurance policies. Also, these broad exclusions might exclude more coverage than originally intended. So these are major issues that have to be addressed and have to look into more, I think. So another aspect is the discussion about the scope of coverage for cyber insurance itself, for standalone cyber insurance policies. The coverage for that has been under pressure as a result of an increasing amount of cyber attacks and increasing amount of damages, which is also a result of the pandemic, I think I might say, because the increasing amount of working from home, for instance. So this development has led to tighter terms for cyber insurance, higher premiums, lower coverage, and in short, a large hardening of the cyber insurance market and questions about insurability. So these are developments. And in addition to that, what I think is quite important, what I see in the cyber insurance market, is that there is more attention to the pre-breach services Insurance companies are investing in risk assessment as a service, so they are collaborating with security firms, and that's a development I think is important in terms of highest level of cybersecurity. So the second aspect I mentioned with regard to cybersecurity in the insurance industry, of course, is being a target as an insurance company yourself. And the developments I see in that field is part of a larger framework on cybersecurity in the financial sector. Of course, in addition to the more general security steps that insurance companies can take, like technical organizational measures, having an incident response plan, there are also very important developments in legislation. And as an example, I will mention the Digital Operational Resilience Act, DORA in brief, which contains far-reaching obligations for financial institutions to increase digital resilience. So these obligations are very specified in terms of governance. There is a very clear rule for board members to be digital savvy, and also very important, this new legislation puts critical IT service providers under the supervisory control of the financial regulator. So this will control the risk of outsourcing, which is very obvious, of course. So yeah, these are the topics I wanted to highlight. Thank you.
Thank you so much, Ninka. Very, very interesting. I mean, a very interesting description of some themes which I think are common to many of these new challenges. So, for example, when you spoke of how cyber can have consequences for other risks, the response of the industry to the increased number of attacks. You mentioned, I think, which was particularly relevant, the greater interest in mitigation measures, which is, you know, in the context of, say, climate risk, is also something very, very, very relevant, and also the impetus that legislation can give. And you mentioned, of course, DORA. Kathleen, is there anything you'd like to add, please, from a US perspective on this cyber issue?
I would actually, and thank you for that. So I think it's, and most people probably know this by now, but at the end of 2021, the National Association of Insurance Commissioners formed a new letter committee, as we call them. This is the Innovation, Cybersecurity, and Technology H Committee, which was really the natural evolution of the executive level Innovation and Technology Task Force that had been formed by the NAIC in 2017. The work of the NAIC as it relates to innovations in technology within the insurance sector, our work respecting cybersecurity and data privacy, will now all fall under the primary jurisdiction of the H Committee. The key drivers of this centralization in really the first letter committee that's been formed by the NAIC in almost 20 years are first the recognition that these issues cut across all areas of the industry. And so our thought processes do need to be centralized, and that's because it's important that our work in these areas be not just comprehensive, but consistent and transparent. And in some cases, that means that a working group has moved under the H Committee from another committee. That's the case with the Privacy Protection Working Group. In other cases, such as considering our regulatory approach to algorithmic bias, it means collaboration and coordination by bringing all the NAIC working groups together under one collaboration forum in order to do our, what I think of as foundational work in that issue. And specifically with respect to cybersecurity, the cybersecurity work group has now been reconstituted under the H Committee. And this year, that working group, which is the group that developed the NAIC's data security model law. So this year, what that working group will be looking at are really three things. The first is the development of a cybersecurity response plan to assist state regulators in looking at situations and responding to situations where cybersecurity events take place within the insurance industry in their market. The second is the development of a cybersecurity survey so that we better understand cybersecurity practices by insurers and looking more specifically in a more detailed way at controls. And then the third area is the development of advice and guidance related to cybersecurity incident response training that would be beneficial to state insurance regulators. So those are three areas of focus this year. And, you know, I think that your original question sort of looked at how the pandemic has only heightened everyone's reliance on digital transactions and communications. And with that comes increased security risks. So it's imperative that insurers have and maintain responsible information security systems and incident response protocols. As I mentioned, the NAIC adopted a data security model law, and that model has now been adopted in 20 states, including in this past legislative session, my home state of Maryland. Those 20 states cover approximately 83% of the market by gross written premium. The NAIC has also been very active in what we a set of tabletop exercises, so bringing in carriers, so on a state-by-state basis, to go through tabletop exercises. And I think that's been particularly helpful in collaborating with industry around how prepared are you, and helping insurance regulators understand how prepared the industry that's operating within its state really is. So they've been particularly fruitful.
Much, Kathleen. Very, very instructive for us in the EU to hear the different structures and tools that are being used in the US. The need for a committee to bring together the different organisations addressing cyber risk, the use of surveys, the use of guidance. All of these are very interesting for us to hear. Thank you. We have looked at four risks here. We've looked at sustainability issues, new challenges, climate protection gap. We've looked at inclusion and diversity. We've looked at the pandemic and cyber risk. Didier, you've already shared some of what the EU is considering in relation to the pandemic in particular. Is there anything else you'd like to share with us, please, on what steps is the Commission taking in relation to these risks?
Thank you, Justin. I hope I'll be able to say that we are taking quite a few of those steps. But maybe before being a bit more specific, I'd like to make a few more general points which I think are relevant in this context. First, I heard Petra this morning saying something very true. I think there are more and more issues which are of direct concern to the insurance industry, but which are in fact challenges which all financial actors and maybe the society as a whole are facing as well. So we'll see, and we are seeing already more and more horizontal rules being added to the requirements which are already, and I would say more traditionally present in the prudential framework applying to insurers. The second point I'd like to make is that politicians, the society, turn more and more their eyes towards what the insurance industry, thanks to its considerable investment power, can do to help them achieving their strategic objectives. Clearly, when you look at the amount of money which the industry manages, there is high potential of contributing, for instance, to the investment needed to fight climate risk and to decarbonize the economy. So this is quite a positive aspect in my view. It's a recognition of the importance of the role the sector can play, and also of its relevance in the current context. So I've mentioned the fact that it was a bit difficult for pandemics, but there is still a lot of things that insurance can do to contribute to big society objectives. But of course, it comes also with challenges, in particular for the regulatory framework, the traditional way I think we have looked at regulation, the need for prudence, the need to protect policyholder and place them at the center of regulation are the traditional objectives. they are still valid today, but of course, they are challenged by the fact that if you want to invest more, for instance, in green assets, you need to accept that to some extent, the need to help innovation can be, let's say, in contradiction with the need to be prudent and avoid risks. So this is a discussion which I think is we need to have, and which is, if you want to have a concrete example, taking place already when I see the kind of debates we are having now around the proposals which we have made in the context of the Solvency II review to foster again the contribution of the insurance industry to the sustainable objectives. So now let me maybe be a little more specific about what the EU does concretely to tackle the risks which have been discussed by the panel. Quite a few things have been said already, but I'd like maybe to wrap these things up a little bit, starting again with sustainable investment. So I've mentioned the what we are doing in the context of the Solvency II review, the fact that we have indeed, as Petra Hielkema said earlier today, mandated the EIOPA to think about these issues, about how to create incentives for more investment in green assets. But we also, as you know, have put in place new requirements to make sure that all insurers look at the impact of their business on their own management, and also have given you, Justin, a mandate to make sure that the capital requirements which are there to deal with catastrophic risks are maintained up to date, considering the, let's say, increased occurrence of climate-related events. We need to make sure that the framework remains fit for purpose, of course. But beyond what we do in Solvency II review, I've said that we see more and more horizontal stuff happening. Obviously, in the sustainable area, the taxonomy regulation is the big novelty, and I have to admit it's the fruit of a lot of work from the EU, and we are front running in this respect, so we are quite proud of it. But it's a very difficult debate, and it's still not over. As you know, there is currently a very difficult discussion about the treatment of nuclear power and gas, and whether this should be considered or not as a way to accompany the transition towards a more sustainable economy. So this decision still needs to be done. But we are also working in the area of corporate reporting. Recent proposals to the CSR regulation should lead to increased reporting in the area of sustainable investment as well. So quite a lot is indeed taking place. So now allow me to say a few words about diversity and inclusion, which is of course also something which we are looking at the EU level. Equal rights is part of our constitutional framework. You know, we have this in our treaty. So the big question for us is how do we translate those principles into legislation when needed? So we are a bit less advanced than we are in the area of sustainable finance, although the EU has been involved in gender equality already now for some time. But there have been some recent interesting development in this field. In particular, we have seen the adoption of a new directive on gender balance among non-executive directors, which was recently approved, which will apply to insurers, but not only to them, of course, because again, this is a horizontal piece of law. So trying to make sure that there will be a balance in terms of gender representation in governing body. And there too, the CSRD proposal will also increase the transparency in terms of equal pay for equal work, and incentivizes insurer to not only to report on that, but also to include these considerations into their own management and into their own investment policies. And by the way, we have also mandated the European body, which is responsible for accounting standards, to become a standard setter in this area. So this is also quite a let's say an interesting and new development. Let me maybe finish by saying a few words about cyber risk. It was mentioned by Nienke already, but it's clearly also something on which we are very active. Doha was mentioned. It's clearly a milestone in terms of EU legislation in this field. It will make sure that all financial actors look at the way they're able to withstand cyber attacks. And it will also, as underlined by Nienke, now ensure that there is oversight of the contractors which these financial entities are using to ensure that they have state-of-the-art IT systems. So we have a comprehensive system which is now going to let's say start being applied, and we hope that it will help the EU financial sector to be better protected against cyber attacks, something which is, of course, quite necessary in the current environment where cyber war is part of the, unfortunately, of the new warfare tools. So, but we do not forget as well, and I finish there, that not only the financial sector should be protected against cyber attack, but it's also potentially, and the insurance industry in particular, a provider itself of protection against those risks. So we are looking very much forward to the development in this market. It still appears to be a nascent market, protection against cyber risk compared to other type of protection. The cost of accessing to it seems to be also increasing. There are issues around also there, a bit like we had with pandemics, the possibility or the risk to see some situation being excluded from the scope of the protection, in particular in case of acts of war. So we need to look at this quite attentively, but it's certainly something which we should promote. And I think that there is a very good strategy that EIOPA adopted a couple of years ago, which sets the scene for the development of that market, which I think could serve as a very good basis for further work in this respect. So I'll stop here. I think these are the key initiatives which we are taking. A bit difficult for me to describe them very quickly like that, but I hope this was useful. Thank you, Justin.
You did it. It was useful. It just shows the width and extent of the work that the Commission is doing on these new challenges. Now, as we come towards the end, there's two things I'd like to do. I'd like to ask the panelists one more quick question each, and I'd like, if it is possible, also to look at least one question from the audience. My question for each of the panelists, and please can I urge you to do a quick response to this, is in terms of the long experience that all of you on the panel have, looking backwards, what was the new risk that was the most unexpected to you? And looking forward, what is your best guess for what the next new risk might be? And let me turn first, please, to Nienke.
Thank you, Justin. Well, what surprised me the most was that when I started looking into cybersecurity as a new risk, which was about 10 years ago, it was all about raising awareness, and I expected that to last a couple of years, 2 years, 3 years, and I often find myself telling the same story now again to raise awareness for this huge problem. So that surprised me quite a lot, I think. So there's a lot of work to be done. Looking forward, I think risks of climate change, which have been discussed extensively at this panel, are really, really pressing risks, which are really hard to control. So I expect a lot from that in terms of how to deal with that insurance-wise. Thank you.
Connor, same questions to you, looking back and looking forward.
Definitely looking back, I have to admit that inflation and affordability really caught me off guard. The speed at which it happened and the impact that it's having already. And I have to admit that notwithstanding all the conversations we had, it was very surprising to see how quickly that's risen to the top of the agenda. What I would say looking ahead, it's very hard for me to pinpoint one. But I would say, at least from where I sit, I would identify three. So the first one, and I'll be very brief, Justin, don't worry. First one is really about longevity and healthcare inflation. I really think there we need to do a better job in terms of equipping the insurance sector to be a strategic partner in terms of how we look at long-term financial and health well-being of citizens. And this is something where I know the insurance sector has a role to play. Second, on the climate risk side, I have to admit it's going to maintain its status as a key topic, but I really do struggle with not understanding why resilience, medium and long-term resilience, economic and social resilience is not at the center of government policymaking. I think that there's more that needs to be done as a whole of government approach and internationally to be able to say that we've actually making meaningful steps in that space. The last one on the cyber side, what I see is market need is increasing, but capital is not. And I think that more needs to be done in terms of being able to bring more capital into the market. I suspect that we're going to have to be looking at this from a public-private perspective. So I'll stop there, but thanks.
Thank you, Connor. Didier, please.
Thank you. Clearly, what we have been going through in the last years is something which we did not wish to see. Pandemics, the return of war in Europe, and on top of that, the climate change. So these are really incredible challenges when you pile them up. And looking ahead, you actually wish that none of these, nothing will add to that, and none of these things will continue to develop in the wrong direction. But if I may maybe express a concern for the future, I would say, but in a very general way, geopolitical shift is for me something which is going to create a lot of uncertainty. First, because we don't know how it will actually develop, but also in terms of what would be its consequences in terms of economic development, access to food, relationships between different parts of the world. So many say that the times of the happy globalization are over. What are we going to see next is still to be designed, in my view.
Yeah, and Kathleen, I'll ask you the same two questions, and I'd like you please to answer or consider one of the questions from the audience. I think we will only have time for one, but I want to get this in. And the question is, thinking about inclusion and diversity, do you consider that gender quotas are necessary? So Kathleen, please, on the risks, looking backwards, looking forwards, and gender quotas.
With respect to risks backward and forwards, I really want to say ditto to what all the other participants have said. I think backwards for me, probably it really was climate in terms of speed and the change of data, and probably how systemic it is across things that we hadn't necessarily thought of. And then going forward, I would say it's climate again. But again, in looking at all of the ways in which it impacts, I think I am mostly concerned about the impact of climate on pandemic risk. So sort of vector-related diseases, and then the tertiary risks that are associated with that, with business interruptions, et cetera. And we're going to see much more impact, I think, on health insurance than we have previously seen. And I'll begin to relate that to climate as well. With regard to inclusion and gender quotas, I would say, at least with respect to the U.S., no, I don't think we're at a place where that makes sense. I think that what we need to continue to do is to work with the insurance sector and identify our expectations around what ought to be happening. But I think to prescribe specifically quotas with respect to any particular characteristic or demographic begins to exceed the scope of our remit as insurance regulators.
Kathleen, and a very interesting final response. Let me sum up by saying that we've had a very fruitful and vivid discussion on 4 areas in particular: sustainability, inclusion and diversity, pandemic, and cyber risk. And we've looked at both the insurance aspects and, of course, how those aspects spill over into society as a whole. We've also learned what our panelists believe may be new risks, and I think actually predominantly not so much new, but increasing manifestations of the existing climate risk. We've heard how these challenges have been tackled both in Europe and in the US. Much food for thought. Now, normally, of course, in a live setting, I'd ask you to show your appreciation to the panel by applause. We can't do that, but from me, really, thank you so much for your contributions, and let's close the panel. Thank you and goodbye.
Thank you very much, Justin. I think before we're heading into break, we briefly check in with Sophie, who as well, again, has done a visual representation of what we just heard in the panel about risks and evolving new risks which should be included into regulatory frameworks. Perhaps we can check in with her now. So here we are. We have a cartoon, like it's work in progress. She's just writing. So we have, of course, sustainability, diversity and inclusion, the pandemic response, cyber damages. So all sorts of new risks emerging because of the changing world we're living in. And you've been pointing that out, I think, very well, that the past couple of years have shown that there is an increasing amount of factors which have to be factored in a way when it comes to new risks. So we not only have the pandemic, we have, of course, cyber, we have the interplay between pandemic and climate change, and something like climate change which is not going away and needs to be tackled as soon as possible. Again, as with the other cartoon, this is work in progress, and if you like, you can check in. I think those cartoons will be online from tomorrow or the day after on IOPA's homepage, and it might be worth to take a bit of time to actually look at them in more details, because there are so many hidden aspects in the cartoon. But for now, we are heading again into a little break, just 10 minutes. We'll be back at 5:30, and then the last panel of the day will be on conduct supervision as a building block to financial health. Thank you very much, and hope that you're joining back after the little break. welcome back here to the last panel of the day. It's moderated by Fausto Parente, who is Executive Director here at IOPA, and he will moderate the panel on conduct supervision as a building block to financial health. And with that, the floor is yours, Fausto.
Thanks a lot, Annette, and thanks to everybody to join this conference today. So we are looking now at another very important topic after protection gap and after new risks, financial health. Financial health is about how people can achieve their financial goal. When we use this term, financial health, we mean that consumer and small and medium entities should have access to insurance and pension products that allow them to have a healthy financial life. They can plan and reach their financial goal and objectives. For some, this might mean buying a house or being able to fund their kids through university. For others, for the more vulnerable groups, this might mean knowing where to turn if they have to fund an unexpected event like a car repair or a broken boiler. Financial health includes also planning, savings, and having coverage to protect against different negative financial events like losing a job or also non-financial shocks like accident. Insurance and pension both play a vital role in this. Insurance protects against unexpected or expected events, and pension provide an adequate income in later life. We at IOPA, we see here two pillars for financial health. One is financial education and the other conduct supervision. Today we want to focus on making sure that the rule design to ensure that insurance products lead to good consumer outcomes are adequately implemented, so supervision, implementation of the rules. And also that consumers are empowered to manage their financial life. With that, I'm pleased to introduce our four panelists. Guillaume Prache, Managing Director at Better Finance. He will represent the consumer angle. Matti Lepala, the Pension Europe, pension industry, has big industry side and also investor side, Secretary General. Welcome, Matti. Nathalie Berger, Director at the European Commission for support to Member States reform. Paul Carty, the Chair of the BIPAL, representing intermediaries, brokers. And Stasis Yakeliunas, I hope to have pronounced not so bad, the member of European Parliament and ECON. So let's start our discussion. Guillaume, I will start with you. Guillaume, do you believe that insurance and pension conduct supervisors are doing enough today to assure that insurance and pension product leads to good consumer outcomes and contribute to their financial health? Where do you see the challenges? What do you think we can do more, or do you think that we have sufficient tools? Where are the challenges, please?
Do you hear me?
Yeah, now we can hear you.
So first, let me thank IOPA for inviting a representative of consumers, of life-insured persons, of pension savers. And I must say we are very pleased to participate to this panel on financial health, because that is what we have been looking for, striving for now many years. And we also think it's an extremely timely topic, because as you probably know, we are at an historical maximum of what economists call financial repression, which is a big positive gap, unfortunately, between inflation, consumer prices, and nominal interest rates.
As you know, today we have inflation in the Eurozone above 8%, and we have nominal interest rates, which are, yes, going sharply up, but not by far that much. Germany is at 1.6, something like that. France 2.2%. So we have a huge gap between interest rates and inflation, and that is called financial repression, because the majority of life insured and pension savers are invested directly or indirectly in fixed income related products. Of course, you have to add to these interest rates, to deduct from these interest rates the costs and fees of all these products. So that is why, to answer your question, I would respectfully like to improve a bit your definition for financial health for pensions. For us, it's not so much a question of access to pension schemes or complementary products to allow them to save enough for retirement. I'm quoting the briefing paper of EIOPA, but it's more like EIOPA is writing for life insurance products, is to have sufficiently positive net real returns in the long term to provide decent pensions and pensions adequacy. Pension adequacy, that the replacement income is not too small compared to your activity income. And we've been saying for a long time that, you know, it's not the paramount factor is not to save a lot for retirement, is not to save early. This is good, provided you have decent returns. On a simple calculation, you can see that if you have a negative return of 1% on your pension savings, and a difference between, if you add 8% in difference, you go from 10% replacement income to 50% replacement income. That is the most important factor before when you start to save and how much you save. So this being said, we are very thankful for all the recent work done by EIOPA, and especially, of course, on the regulatory statement on, supervisory statement on the value for money for unit-linked products. I would mention also for the last 2-3 years, the report on costs and performance, because you cannot supervise and you cannot manage what you cannot measure. And so that's a very good start. And again, having a topic today on this and having further work done on value for money is very important. As you know, as an advocate for consumers, and Fausto, you know me, of course, we have a tendency to look to the half empty glass and not only at the half full glass, so, which is good because it means you have still plenty of things to do in the future for consumers, for insured people and pension savers. And so I would add to add a few things on your on your to-do list, because that is your question. First, on this collecting the data, as I say often, you know, the king is naked. The ISAs do not have a database of the products they are supposed to supervise. And that is especially true for EIOPA, and especially a challenge for EIOPA because it is a very complex and fragmented landscape of products, life insurance products, pension products, personal ones, collective ones, etc. So this is very important, and also I will not say right now, but we would like to discuss further improvements in terms of scope and methodologies of your cost and performance report. We need to start to doing that. We need to have KPIs and key performance indicators, so to measure the outcomes, to measure not only investment objectives, but also pension adequacy, protection against the risk of long age, and also how to protect the purchasing power of pensioners, so the how to address inflation risk, etc. By the way, there is an excellent paper just published by the ESMA stakeholder group on investor protection and inflation. I strongly recommend, because we are today, this year, we think we are going to lose in terms of real value, in terms of purchasing power, European savers, at least 1 trillion euros. 1 trillion euros. That is why value for money is important. And on top of this, policymakers and industry have a tendency to exploit our behavioral biases on the impact of inflation, the compounded impact of inflation. Economists have studied this at length, instead of trying to mitigate them and address them. Last, maybe 2 points I would like to make, because I see you are looking at your watch already, but that is your job. Please, when you do this, don't work in silos. I know by construction, because EU law on investor protection, saver protection, pension saver protection is in silos, you are also working in silos. But ESMA is also doing a lot of interesting things right now with several NCAs on value for money. And as you know, the building blocks of a lot of life insurance products and of pension products are investment funds. And investment funds, they are regulated and supervised separately. So if you are not consistent, we will lose effectiveness. So that's what the 1 point before. My last point is that you need help, and we need to improve EU legal requirements. And there is this retail investor strategy going on, where we really hope it will do what it says. So the objective, especially to have a clear, simple, and comparable key information. We don't right now, as you know. And to ensure, I'm quoting the European Commission, to ensure bias-free advice. We have huge tons of evidence how detrimental it is on the long-term returns to have a dominant model where we have bias advice. Thank you.
A lot, Guillaume. A lot already as a first start, already a lot of item in our to-do list. Thanks for the contribution. Maybe now moving a bit to Nathalie. Nathalie, as a DG Reform, we know that is contributing to help also supervisory community. What is that we can expect that you can do to help the supervisory community? We saw that Guillaume mentioned some gaps, some additional efforts that the community should do. What's your view? What we can expect from you, from your support, please?
Thank you very much, Fausto. It's a real pleasure to be back with EIOPA again at an EIOPA annual conference, and to be meeting again with people and stakeholders with whom I had the pleasure to interact in a not too long ago past. I think today's is really an excellent opportunity to reflect on how the financial services supervisors and other public sector institutions may help in reinforcing the health of the financial services consumers. In that regard, with our technical support instrument, our Directorate General, working together, of course, with the colleagues in charge of the regulatory policy, Didier Miero and his colleagues at FISMA, we play an increasingly important role in supporting a much awaited paradigm shift among the national authorities in the context of business supervision, complementing, of course, the extensive regulatory efforts that are being pursued by the Commission and by the ESAs and by EIOPA in particular in the last 10 years. We do feel responsible for ensuring consumers' trust within the single market And we help the supervisors in achieving this common goal with our technical support. So our programs allows us to bring technical support directly to the reforms in the member states that are going to contribute to increasing conduct supervision. We observe an increasing need to efficiently identify and tackle market-wide and institution-specific risks that might ultimately harm consumers' interests. Our technical support is at the forefront in assisting with the development of dedicated conduct of business supervisory tools and the transitioning to a risk-based, forward-looking approach to consumer protection. This is a substantial effort, given that the conduct of business has not always been the focus of financial supervision for many years. And in the insurance and pension sector, we have been and are supporting supervisors in several member states, including in Italy, Romania, Croatia, Portugal, Greece, Ireland, and Hungary. These initiatives share a consumer-centric approach, prompting a transition from a compliance-based supervision to a risk-based, outcome-focused one through robust data analysis and comprehensive methodologies. One clear example that I would like to mention is the support that we provided on and the integration of the mystery shopping tool in the conduct of business insurance supervision in Italy. We've done this with EVAS. The project entailed the conceptualization and the testing of an instrument empowering the insurance supervisor to analyze not only how certain products are being sold in a market, but also what specific outcomes and risks these produce for consumers in real-life situations. And of course, I'm pleased to underline that in order to carry out this work, we have established a strong and excellent partnership with EIOPA. EIOPA strove in establishing a conduct of business culture within the supervisory community, and we're very happy to work together for equipping the supervisors with robust methodological approaches to identify and to tackle the consumer risks. And this year, we are launching an even more challenging technical support project aiming at enhancing the conduct of business methodologies used by two supervisory authorities in their respective insurance and banking sector in Croatia. We are well aware that consumers face different risks and pursue different interests when buying an insurance or asking for a loan. However, the conduct of business supervisory methodologies can benefit of cross-sectoral synergies, enabling competent authorities to truly embrace a broader perspective of consumers' financial health when tackling market and institution-specific risks. And last but not least, I'm thinking of Didier Miro's intervention and the reference he made to the cyber risk as being a major risk that we are facing in the future. And I'm just thinking of the current context of the war in Ukraine and the risk that some may use crypto assets to circumvent sanctions. For this year, we are launching together with the European supervisory authorities and with EIOPA, we are launching an EU supervisory digital academy, also with the European University Institute of Florence, to contribute to develop the supervision of digital finance, of course, to the benefit of enhanced consumer protection, and also to contribute to building up a digital supervision academy, a community of supervisors in the area of digital supervision. So there is a lot we can do through a very careful articulation between the regulatory activities, the legislative reforms, and the technical support to concrete projects on the ground. Thank you very much.
Thank you, Natalie. Important project that you mentioned. among which you also mentioned the mystery shopping. And I'm turning now to Paul, representing the intermediary advisor. So mystery shopping is something that we use as a supervisor to assess how the intermediary help the consumer to understand better their needs and so on. Do you think, Paul, that the intermediary have a role in ensuring financial health? What's your view, please?
Thank you, Fausto. I've been listening since the very beginning this morning, so thank you for allowing me to participate. Been so useful. Indeed, I've been writing copious notes, which I may refer to because it's all so interesting. It's such a large topic that you're discussing. Think about what we have covered so far today. There was mention of mobile phone insurance, to cyber, to pensions. They are poles apart, yet share some sort of a common link. So it's an enormous area. I'm going to come to intermediaries shortly, but I want to frame what I'm perhaps going to say. Then you've Commissioner McGuinness, obviously highlighting CMU, the retail investment strategy, mentioning financial education. Clearly, we have a role there. Information disclosure and empowerment of consumers. There were the points I took there. Then we had the advice gaps, which were also subject to discussion, which Petra Hielkema mentioned, and they were advice, pensions, digital, protection, sustainability. I was taking notes, as you can see. Then we went on to panel one, and we looked at the behaviours. We looked at what people are. They're not what they want them to be, it's how we behave. And we had Monique again representing consumers like Guillaume here, and making her point. And I thought there were 2 points I picked up on. Was she used the word procrastination, and then used the term nudging in a number of contexts. So where does that bring me to intermediaries? Well, quite frankly, yes, I think we have a very central role to play in financial well-being, financial health of consumers. I think we all have our parts to play. I think this is a multifaceted issue. It encompasses education, where we clearly have a role to play. I think we have a very detailed regulatory backdrop, and I'm going to go to that word nudging, because nudging can be good and nudging can be bad. So we must get our contexts right. Michaela Kohler mentioned that we have a very, very highly regulated and quite a mature regulated market at this stage. So if we get our context right, if we obey the rules we have in place currently, from doing the appropriateness, the suitability, the demands and needs, all of that, imparting the information to the consumer, I think good decisions can be made. And in that context, there's nothing wrong with providing advice that takes the form of a nudge, gentle nudge, but that's the context, professional, to take steps to protect yourself, to invest in your pension. Don't postpone it for another year. Start with something. That's a gentle nudge in the right direction. So I think we have roles to play. Now, as to the specifics of your question, Fausto, you asked about the mystery shopping. Is it a tool? Of course it's a tool. And I think it's relevant in what I have said for this reason. Regulation, as I said, is mature. We don't need more. We need to make sure that what we have has been implemented properly. We are using the tools that we have. Mystery shopping is part of that. You must test it everywhere. If there's a case that it is proven that it is not doing what it should be doing, we should then look at seeing what changes need to be made. But I challenge that hasn't been done correctly. So we intermediary. Another point I want to make is my interest as an intermediary and as the people I represent. I'm interested in a relationship with individuals and companies that's longer term. It's not about the sale of the next contract. I have a lifetime relationship with people. This is a dynamic environment. People's circumstances change over time. It needs to be constantly reviewed. You have to know people. And that's also very, very important. So we have to take a slightly more holistic approach in terms of the longevity of the relationship, certainly that we have, which is frequently over the full lifetime of either a consumer or indeed a company. Thank you. Thank you, Fausto.
Thanks a lot, Paul. So you are happy to that we check, let's say, how the rules are implemented, because the rules are mature enough that we don't need so much more. A point taken. Stasis, can I turn to you in the context of trends where we see much more than in the past data-driven business model? What is your take? What do you think supervisor can do? They have the right tool to monitor how the rule implemented and how to assess it, please? Stasis.
Yes, thank you. Thank you for inviting me and for having this opportunity to share and also to listen. Yes, let me start with the general trend of digitalization of finance, which is going on for years already, but now currently with the so-called platformization and big tech, big data, as you mentioned, artificial intelligence, machine learning. I think this trend is picking up, and I'm really glad to hear that Natalie mentioned the Supervisory Digital Academy. I think that's really needed, and maybe we need to grow based on that into something even more important at the European level as far as financial business conduct supervision is concerned. But let me illustrate what's happening in the digital space, of course, on the limited time and the limited specific case from one recent example from my home country, Lithuania. There is a neobank which was created recently, and it's using the platform and applications to sell its own, banking products naturally, but also insurance products, and also crypto asset, products. And one recent trade went wrong because some pricing models were not transparent enough. Communication was not good with the clients, so naturally clients addressed their concerns and their complaints to the National Competent Authority. But what transpired during the process that when they entered the platform or application in order to get this access to trade in crypto assets, they entered several jurisdictions at the same time, and one of them, which was responsible for this administering this trade, was from the UK, not even from the European Union. So people entered in one spot and then ended up, after the National Competent Authority responded to their complaints, that this is another company, it's in the UK, so go ahead and complain to the Financial Conduct Authority. So seamless entrance, seamless use of digital space resulted in the physical application, writing, communicating, different jurisdiction, different regulation, different language, foreign language, with FSA. So this illustrates to me that this digital era is full of surprises, sometimes good surprises. It's good to have choice. It's good to have convenience. It's good to have this seamless, access. But if things are not managed well at the company level, if not supervised well at the supervisory level, then they may end in the problem, as this is the case. So, and then since I'm in finance for several decades on the several areas, and from the commercial, from the public arena, banking and insurance too, I was in touch with this National Supervisory Authority for a number of years. And what I learned and what I see now, that they operate on the case-by-case basis. So no mystery shopping, as far as they know, is conducted by the supervisor to test how the products are communicated and sold, especially in the digital era, when I don't know if they can have access to that if they are not client of this company. So I think that's the principle that has to be coordinated and ideally changed at the European level. There has to be proactive and systemic, business conduct supervision and consumer protection. If that's not the case, then we may accumulate major asymmetries, consumers versus businesses, and even I think assets and supervisors versus businesses, because big tech, using all their resources and big data and financial resources are realistically unlimited to follow what business models they develop, how they use that, how they embed biases and other behavioral aspects intentionally or sometimes unintentionally is a real challenge, I think. So for me, this supervisory digital academy, I think, needs to grow and maybe to become a counterpart, ideally, or maybe something else has to be done. Yesterday, for example, we had a meeting with the European Systemic Risk Board Chair, Christine Lagarde. One of her roles is to chair this interinstitutional arrangement, which coordinates, I think, assets and also involves the academicians and other stakeholders in order to see how risks develop in the housing market, etc., and how they could be handled. So I think there has to be a counterpart to this institution, because when I asked the question to her related to the consumer protection and the abuses in other area, in the mortgage lending specifically, well, she was focusing on the financial stability and the capital ratios mostly. So there is a different set of skills and mindset that needs to be developed in order to have this balance of looking after the companies and also protecting consumers on a systemic and proactive way at the European level. So let's think about it. Behavioral academicians could be part of that naturally, as there was discussion this morning. So yeah.
As you know, policyholder protection is at the core of our mandate. So I'm sure that this will be our task for the one.
Yeah.
But thanks a lot.
Thank you.
Can I just turn to Matti, maybe, because today we have been talking a lot about closing the pension gap, and I want to hear from Matti what is his take on this. Do you think supervisors have a role here in helping industry to close the pension gap? What we can do more? Matti.
Yeah, thanks Fausto. Very glad to be part of this panel discussion. The pension gap is a real issue, of course, but then what is meant by the pension gap, I think it's good to define it a bit. So I think the big problem is the difference between the income needed for a reasonable standard of living and then the difference with the actual amount saved, but then also considering the public pay-as-you-go pensions. So there is a pension gap. We have other pension gaps. We have a pension gender gap, for example, which is another big issue. But then for European Union, of course, the intention and the policy is to deal with the pension gap, to provide adequate and sustainable pensions, and sustainable here meaning not the present sustainability debate, but sustainable meaning the ability to continue over a long-term time horizon. So the economic definition of sustainable. And of course, the underlying issue is the changing demographic situation and the worsening old age dependency ratio, which means that this is a major challenge for most European pension systems. And the design of the pension system is, of course, up to the member states. And it's clear that in many cases, what they have designed will not work, meaning that increasingly people will not have adequate pensions from the sources that they have. And for the most part, that comes from the public social security pensions, and with the demographic change and then the increasing debt and deficit levels, it's clear that this will not provide adequate pensions going forward without people saving more. So more people need to save more for themselves, and how that is done is an important and difficult question. And I think that context supervision, as it is understood to be about securing appropriate protection, it is important. But then it is important to define who needs protection. Is the risk with the sponsor company, or is it with the employee as a member or a beneficiary? Is it about investment risk, cost and charges, longevity risks, payout phase risks? What are the risks? And of course, supervisors play an important role in many of these issues, but pensions are first and foremost not products that are sold to consumers. By far, the most retirement income comes from Social Security and workplace or occupational pensions, which are often based on collective agreements, and they can be often mandatory schemes. And in looking at this issue, the triangular relationship between the employer, employee, and the IRB is important and highlights the difference with consumer products. So IRBs are social institutions that are offering financial services. But it's also clear that in all pensions, also in Social Security pensions, risks are increasingly shifted towards individuals, and that emphasizes their need to know what the risks are and what can they do about them. Good communication, transparency, understandable information, reliable projections, and the possibility to do something based on realistic understanding of one's situation. Those are crucial issues. And then, of course, good quality pension solutions and good quality pension products for those who need them, and proper supervision is important for achieving this. And I think that supervisors are in a good position to identify many of these problems and that lead to pension gaps, such as prudential frameworks and cost and charges. And as I think Guillaume rightly pointed out, it's not just about saving, it's about saving effectively, that you get good real returns. That is crucial. But however, I mean, in this, like, what is the role of supervisors in pension gaps? I think it's also important to recognize and respect the distinction between what is policy and who are the policymakers and who are the supervisors. And of course, supervision is very much about compliance. But I think Natalie, you also said about the other side of not just compliance, but also looking at the outcomes. And I think also in pensions, whatever pensions are in the supervisory sphere, I think it's also to consider what are the impact of supervisory actions on the outcomes. But I do think that good conduct supervision is, of course, very crucial in pensions, increasingly in all pensions, and of course, definitely in personal pension products that are sold to consumers. Those are consumer products, but there are distinctions, and it's a very diverse and complex landscape that we're dealing with.
Also good quality pension solution. This is good to hear. May I maybe just now turn a bit on the audience, because I want to hear from audience asking a question behind what we are been talking about, conduct supervision, which is the key element to ensure consumer financial health. What other elements are necessary in the view of the audience? We listed here something, financial education, investing in activities with a social dimension, microcredit, microinsurance, digitalization, improved financial advice. Let's see if our audience can give us some good hints on what more we need to focus. Let's wait a bit for the outcome. Giving team. Yeah, here are some preliminary result. Naturally, financial education emerges like another important tool. We said since the start that it's the other pillar on which we need to base it. Okay, it seems to be quite a almost unanimous vote that the financial education is the other. But then talking about financial education, maybe Natalie, if you still have some moment to mention it, the financial education is the other key element, as we have seen also in the outcome. What DG reform is doing on it? You already mentioned some important initiative, specifically on DG, on the financial education. Please, Natalie. Quickly, because we are running short. Go.
Thank you. I will go very quick because unfortunately I will have to leave you afterwards. We are very well aware of the positive role of financial education initiatives in ensuring the empowerment of consumers and increasing their confidence. And if we look at the latest figures from the OECD, we can see that the average financial knowledge is very low. I mean, 4.4 out of 7. And the financial behavior is assessed at 5.3 out of 9. So it proves that in some cases, people are aware of behaviors that would be good for their financial health, but somehow do not act accordingly. And this is particularly true with regard to insurance and pension products, which are crucial in addressing individual detrimental tendencies observed. I mean, I'm thinking of underestimating the probability of risks and not taking action for long-term needs. So risks and planning are 2 out of 4 pillars of the financial competence framework that the Commission issued earlier this year together with the OECD and in cooperation with the member states. And it provides a basis to assess the level of financial literacy, to design financial education, and more generally to enlist the basic skills, ensuring that finance serves the needs of the citizens and the SMEs. Besides these efforts, we in DG Reform have been supporting more than a dozen member states in the area of financial literacy, targeting various parties, including SMEs, investors, and individuals. Our initiatives range from the development of national financial literacy strategies, we've done that in Austria, Poland, and Greece, to their implementation in Austria, Cyprus, Bulgaria, and France, through the development of dedicated tools easily available and accessible to citizens, including the design of learning platforms based on data analytics techniques, and we've done that in Belgium. We also supported actions targeting SMEs to raise their awareness of financing possibilities offered by the capital markets, and notably in Czechia. Time allowing, I wish I could show you a web TV series that we produced together with other practical solutions like a self-assessment quiz, an online tool for organizing household finances, or games for school pupils. And our web TV series is in Italy, and you could follow the adventures of Diego. They're very funny. And the fact that they're funny and light in a way ensures us a swift and a good and easy communication to the wider stakeholders and the not fully financially literate. Our financial literacy engagement is increasingly linked with new important trends. First, digitalization, and thus we are supporting the development of financial literacy strategies focused on the challenges of the digitalization in Portugal and soon to start in France. And we're also aware that efforts towards sustainability will require heightened consumers, investors, and policyholders' awareness with respect to their financial choices. Indeed, financial literacy should be included in initiatives tackling greenwashing. And we're open to increase our efforts in this area, also under our new flagship project on ESG risk management for supervisory authorities that we are proposing for the next year. So you see, we have a wide experience, and we continue to support to the best extent possible initiatives in the member states and with the European supervisory authorities to contribute to increased financial literacy in the European Union. Thank you very much.
A lot, Natalie. We see that we can count for sure on the Commission support. Guillaume, very shortly, because we don't have so much time. You mentioned about the data, the cost, the performance, the comparability of product. Financial education, is it sufficient?
Well, if it was widespread to European adults, would be a big step forward. But this survey that you just showed also is quite interesting, that the 50% request from conduct supervisors like EIOPA to do more on financial education, because your powers are extremely limited there, but all the EU authorities have very limited power there. So I don't know if your audience is a majority of consumers. because you will, believe me, you will not get consumers, us, back to school for financial courses. The only way you can get adults who have another life, you know, it's not a full-time job to be a financial user to school, is when you require from them a license. And that's why we are going back to school to get our driving license to be able to drive cars, but that's the only case. So all these initiatives from public authorities, like the ones Nathalie mentioned, EIOPA is doing, the National Competent Authority, the industry are doing, are good, but they will not create a significantly higher level of financial literacy. What will create a significantly higher level of financial literacy is from people they talk to. And people they talk to on these topics is the retail point of sale. That is why it is critical for the Commission and for us that at the retail point of sale, they get information and education, not biased advice, because biased advice is anything but education. And that doesn't mean the role of supervisors is not key, because you don't only need a bias-free advice at the point of sale, you need also relevant, intelligible, comparable information, and you need two other things: simple products. As you know, Fausto, there is a legal requirement for European supervisory authorities to promote simplicity, and there is an upcoming Better Finance report on this. Simple products and insurance and pension products are often very complex. And lastly, supervisors could help a lot to use their product intervention powers, at least on the most egregious cases that we and others are pointing out to EIOPA and others. Thank you.
Thanks a lot. I will turn immediately then to Paul, the question on the retail point of sale, which is key in that regard. So, but before, Matti, what about the pension sector as one of the biggest investors in maybe ensuring that there is enough investment that we can help financial health also with the investment side? What is your take here? The pension sector is doing enough? It can do more? What are the challenges, if you see any challenge?
Of course, in the overall investment landscape, there are plenty of challenges now with the interest rates and inflation and the whole global economy being in flux. So of course, there's plenty. Specifically, of course, important issues, and also for the broader policy goals of European Union, and even more broadly, are the sustainable finance issues and sustainable investments. And I think there's a lot of challenges and opportunities. Of course, the landscape in regulation is changing very much, putting new requirements on both investors but also investee companies, and I think they are both important. Also, looking then specifically at the investment rules of pension funds, we of course have the European rule, the prudent person principle, and we have then the basic fiduciary duty of the pension funds to act in the best long-term interest of the members and beneficiaries, and that is something that is, of course, now to be considered by EIOPA together with stakeholders. I mean, you received a call for advice yesterday from the European Commission, as was mentioned earlier this morning, and as part of this work, you will be considering these issues. What are the basic investment rules, and what is the role of pension funds in this, and how they consider the ESG issues, and those are really crucial, and of course have a big impact on pension funds as investors, and how they can contribute to the green transition, and helping also not just in environmental issues, but also in with social investments, and even with impact investing going forward.
Good, thanks a lot. Stasis, on your side, what additional measure we can take to close pension gap?
Yeah, let me move closer to EIOPA's mandate, even though what I'll be telling is not within the mandate, but it should be, I think. That's the private pensions. Matti mentioned that a number of times already. And I was involved with the private pension system in Lithuania starting from 2003 or 4, when I was on the commercial side of the thing. But then in 2018, I initiated the restructuring of this pension fund, private pension system, because it was financed by the pay-as-you-go system. Pay-as-you-go system benefits were reduced for the future retired people by 10 to 12%, and the current pensioners, retired people, also got lower pensions because of low contributions generally and low wages, etc., etc. I will tell you that at that time, average pension, monthly pension from pay-as-you-go was 200 to 300 euros per month. And that as a result of these low levels of income, people who accumulated amounts of money in the funded pension system reached only several hundred, in some cases several thousand euros. So they either cashed it out or, surprisingly for me, but behaviorally could be explained, they left it in the pension fund system in order to inherit by their children, etc., by their grandchildren. So the outcome was they received a lower pension, and the replacement ratio was lower than that. So we restructured this thing with lots of fight from the industry and also from some politicians in the parliament, national parliament, which seem to think that anything private is much better than public. So that was a bias, I think, but we managed to limit this funding from pay-as-you-go system to the private pension system. Paradoxically, at that time, we introduced the life cycle investment principle, which is now turning on its head with all the inflation and negative real return. So we'll have to think about what to do with that. But other countries, Czech Republic, Hungary, Poland, and other countries, especially in Eastern Europe, had more or less similar arrangements, which are not sustainable, and they discredited, in a sense, the financial system, at least the pension system. So I think we need to be very careful how we move forward, because it has serious implications in many aspects, including the market union, etc., and trust in the institutions. So I think at the European level, we need to cover and to close this gap in the private pension systems. Otherwise, the experiments will continue, and we may have more problems in the future.
Thanks a lot, Stasis. And just to pick up the question from also the solicitation from Guillaume, Paul, what's your view on the intermediary side? You play a key role, it seems, on also in educating and advising people on their needs. What do you think you can do more? Is there any need to enhance? You already covered a bit the regulatory framework, but please.
Yeah, I agree with Guillaume in this regard. People aren't going back to school, and I also agree with him that the key point in reality is at the retail end of the business, where you interact with the consumer at the point of sale. And education is part of that process. It's inherent. Maybe it needs to be a little more obvious. Maybe we need to take a stand back and think about how that can be enhanced. Matters can always be enhanced. But to go to the point about financial health. Financial health is about monitoring risk and planning. There are two facets. I mean, there are all sorts of examples one can give that intermediaries engage in every day of the week. The most simple thing of the moment might be discussing your household insurance and the adequacy or not of how your household is actually insured, given the state of inflation, particularly in the construction sector. That's a form of education. In terms of financial well-being, to give you a life example, having to do with demands and needs. If I was speaking to a self-employed man or woman, I would first be checking, particularly if they have family, are they insured? Have they protected their income if they're self-employed? then talk about investments or their priorities. There's lots of education in this. If it goes to the pension arena, well, that is much more technical in many respects. And yes, you're inevitably educating the consumer regarding their options in terms of funding, their options in terms of investment, what they need to fund to achieve what their expected outcomes should be, and the dangers that are inherent in this. So education is absolutely integral. We don't think of it, though, formally as being so, but it is. And I have a bias, I have to admit. And I firmly believe most intermediaries have. I have a bias on behalf of my client, an absolute bias on behalf of my client. And some of my biggest competitors are, in fact, other intermediaries. So if I don't fulfill that, I have a difficulty. So it's inherent in the trust you build up over a long term with the client, that you walk them through the various scenarios they have in their life, which is protecting their assets, protecting themselves in the circumstances of early death, income continuance, pensions, the whole gamut is there. Could it be improved?
Then this means that this can be incorporated into the financial advice process. That is my understanding, right? It's naturally part of it, right?
Naturally, it is built in. It is inherent in it.
Good. No, thanks a lot, Paul. Maybe I want to turn now again to the audience for a last question, because now you have listened to all our panelists. So after having listened to it, do you believe that insurance and pension products that are contributing enough to promoting consumer financial health? Please try to give answer. Yes, broadly, I believe so. No, yes, but only some product. Please, let's see what is the take from the audience. Yeah, it seems that the inflation is one of the naturally the most concern. Yeah, different results. So some product for sure, yes, but there is also a concern about how inflation can determine it. Good, thanks a lot. Thanks a lot for it. Maybe, I don't know if there is still a moment for one question from the audience, or let me see. Talking about inflation, maybe. Yeah. What are the challenges in achieving financial health given the current macroeconomic environment, inflation and war? Who wants to take it up? Guillaume, you mentioned something already, but maybe others wants to try to answer?
I could say something, Fausto. Just
yes, please go, Matti.
This highlights the fact that it really depends on what we are talking about. Like for the social security pensions, the inflation protection can be very different than for a personal pension product. So it's the totality of how people are covered and what are the protections. Are you in a defined benefit scheme where the risk is with the employer? Are you with your own risk in a defined contribution? It all depends. And during your working life, you can be in very different systems with very different protections. And of course, crises like high inflation now just highlights the fact that it's very complex, and you need to have a clear understanding what is your actual situation and what can you do about it.
The other wants to jump in? Stasis, please.
Yeah, briefly. Well, let me move to another area that Christine Lagarde represented yesterday at the European Parliament. That's the president of the European Central Bank, responsible for the monetary policy. So, there are lots of discussion comparing monetary policy, especially interest rate decisions compared to Switzerland, to United States. So most likely will stay with the inflation, at least for the foreseeable future, because the central bank, European Central Bank, will be afraid to go ahead with the significant and more fast interest rates, because there is a risk of disintegration of the public debt, etc., in places like Italy, Greece, and other places. So we'll have to deal with this inflation at least for several more years. So that's a risk that remains. So we have to be aware of that. And I don't know I don't have the answers, but that's the risk that we'll have to calculate both from the supervisory point of view, from the consumer's point of view, for the foreseeable future. So, thank you.
Paul or Guillaume, last word on this? Guillaume, please. You raise your hand.
Just one word which I did not mention before, Fausto, is that you should start, I mean, the policymakers should start by disclosing or requiring to disclose the impact of inflation on the financial health, on the outcomes, and on the long-term returns of financial users. I think that would be a first step. Thanks.
Thanks. Paul, how you can explain inflation to your clients, please?
That would be part of a normal review. This inflationary period cannot be escaped, and it's not only going to eat into existing savings, as has been described, but the ability of people to actually fund their long-term savings over the next period. So sometimes clients resolve in terms of their keeping up their level of investment, particularly into their pensions, needs to be strengthened. But sometimes it's simply not possible. Such as the inflationary pressures currently, and unfortunately we may move into a recession. So we're in very difficult times, I'm afraid.
Thanks a lot, and your role is key also in talking with people. Thanks a lot. Thanks to the panelists. We can close the panel now.
Thank you very much, Fausto. Stay here. You still have a very important role to play. But before I'm handing it over to Petra and Fausto, I would like to check in with Sophie once again, as we've done with the other panels. Sophie also has drawn a cartoon on the third panel discussion here in the afternoon, so perhaps we cross over to her. I think it's still work in progress, like with the other one as well. It might actually be. We are seeing what she writing right now? Yes, indeed, she's saying. So she will be, she'll keep on working on that cartoon during the afternoon, I guess. We have a variety of topics here on the topic of financial health. Of course, the pension gap was again very prominent. Financial competence framework is in the center of the attention. Then we have the EU Supervisory Digital Academy, who is of course like a think tank working on financial education. So we have the key question is whether nudging is good or bad. Mystery shopping. So there's a variety of topics which is covered in that cartoon. And again, as with the other cartoons, you can check back in to IOPA's homepage and have a look at it with a bit more time, because there are so many details in it that it's probably impossible to actually grasp the whole variety in just a minute or two. With that, I would like to ask Petra, also coming back here to the stage, our little stage here, and I would like to actually say goodbye from my behalf. It was a very enjoyable day. Thank you very much.
Thank you. Thank you, Annette. And thank you, Fausto. Thank you for a great final panel. And just happy to hear your takeaways from that one, but maybe also for the rest of the day.
Yeah, maybe some first of all, good, excellent input to our work, to our work plan. I mean, I can, in the starting from the last panel, maybe I see that inflation is actually on top of our mind right now, and for good reason. It's the whole day we are talking about risk, new risk, and this is something that we could have really. Anyway, some work needs to be done on this in this area. There is a clear demand from also consumer association to explain it better. There are good input on how we can further improve conduct supervision. for example, collecting more data on the product. This is a direction that we want to go, but it's, we also see the challenges. There were important quote about our effort to improve the digital academy that we are in. We're starting now, so there is a need to enhance our skill. Because someone said, Stasis, no, digital is full of surprise, and we need to manage the surprise to only harness the benefit of this surprise. So proper supervision is key, and the skills in the supervisory community needs to be continuously updated and enhanced. So this is a clear takeaway that I'm taking. Also thinking about the other panel, I don't want to take it too long, of course, because summarizing the entire day is difficult, but there is a clear, some good food for thought, and maybe also honestly some confirmation of our thinking. So for example, this morning, the economic, the behavioral economic that now recently more and more supervisory communities having in mind when designing and providing advice to the Commission. The need to keep updated the legislative framework, industry claims for better disclosure of the specificity of the product. This is something that we also have in mind. We are advising the Commission on the retail strategy, on Solvency II we did our job, on the PRIPS we are advising. So let's see, I think that it's important message that we got, confirmation, good food for thought, and ideas to always continuously improve. These are my take. Let's summarize, but I'm interested in hearing your take, Petra. What's
Well, first of all, I think it was a great day. I think everyone did a wonderful job, including yourself. Also, I think that if you look at where we started, where we said there's new challenges, I think we agree on that. Sometimes they're really unexpected. I also heard challenges we knew they would be there, but they're maybe bigger or different than we thought. I think there was full agreement on that there were gaps, and also a willingness to deal with gaps from all the stakeholders in the discussion. I think that's positive, even though we see, of course, the challenges in there. And I think, moreover, we all recognize that it's all urgent, it's all in parallel, and working together will help. At the same time, I clearly heard, particularly in the second panel, that supervisors, as we are, we're not jumping immediately into all kinds of actions. We can add value by tracking, by understanding, by sharing that knowledge, and together in collaboration understand what we can do moving forward. And one of my takeaways is that we realize that even though we are in the middle of a technical and a digital evolution, big change indeed, it's not all that tech when you think about solutions, because it's often about putting the human back in the center of the discussion and think about their needs, realizing that the consumer is a very diverse group of people. We clearly heard that this group of people is not going back to school to really learn what insurance is. So we need to find other ways to have them indeed in the center through transparency and clear information, but also through simple products. And the role of advice will be important here in helping people make the right choices. I think what was also said, and I also liked hearing that, to be frank, is that we need to recognize that strong regulation and strong supervision also helps the certainty that consumers feel when they buy these products. And also this can help. And I would say that with that we've identified, I think, a lot of topics to move forward on. I heard a lot of willingness to do that together. I think we all realize we can do that and will do that in a technical transformation age with technical tools, but we're all very conscious also of the role that people have in that. And with that, I'll stop, but I'll stick to people because we're at the end of this conference. And this would not have happened in the way it did if it wasn't for many people contributing. So I want to thank them very much. And I'll start with our keynote speakers, Vicky Saporta and indeed Commissioner McGuinness. I was very happy they joined. I listened with a lot of interest, and I'm very happy with their contributions.
And if I may also thanks all the panelists, Justin, Pamela, our colleague that moderated the other panel. So thanks a lot to all the panelists.
Yes, and of course thanks to you. You were a panelist.
Yeah, me myself as well. Yeah.
And Annette, who moderated very well. It's very good to have an excellent master of ceremony. And while we were all talking, of course, also Sophie, who is making these great drawings and helping us to actually memorize what we learned today. So thanks, Sophie, thanks to you. And last but definitely not least, thanks to all IOPA staff who made this happen. This is a lot of work always behind the scenes. It's a lot more hours than should be according to certain schedules, but people are putting it in. There's a very good team, I think by now smiling behind the camera, and I'm very happy and very grateful that I have the opportunity to work with such great people.
Yeah, me too. And of course, first of all, you, the excellent speech, by the way, this morning. So congratulations and thanks a lot. And also I want to thank all the audience that participated. It was a long but interesting day, I'm sure. So thanks a lot to everybody for joining this conference.
Indeed. Thank you very much. I wish you a very good evening, afternoon, or other part of the day, but I was moreover very happy that you were able to join us, and I do hope to see you somewhere around in the circles of insurance and pensions, or maybe next year at the conference. Bye-bye.